Okay. Let me know everything's coming through loud and clear. Good to see you already, my man. Glad you can make it. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is Wednesday, July 14th, 2021 at 8 p.m. Eastern Standard Time. And like always, before we get started, I would like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Okay, so I want to get started just a little bit different today before we jump into all these charts and go through our normal routine. I want to start with two different things here. The first one is, let's see. So just a couple little blurbs out of one of my favorite books. This one is Stock Market Technique #1. If you have not purchased this book or read this book, I highly recommend it, even if you're not a reader. It's basically like a series of articles put together by, it's Richard D. Wyckoff. And essentially it's just a bunch of like newspaper articles or magazine articles from like the 1930s. And basically it's just a bunch of awesome and amazing information. And one of the sections inside of here is just, it's called Flashes right in the beginning of the book. And it's basically just a bunch of like little one-liners. And if you ever have trouble with just useful little bits of information, that's exactly what this book is perfect for. There's definitely some things that are outdated. A lot of these excellent books from, 50 to 100 years ago, even 30 years ago, there's a lot of like bond and portfolio weighting stuff in here that just really doesn't apply in the same situation that we're in now. But overall, they are literally just loaded with gems. So we're going to talk about a couple of them, and then I'm going to talk a little bit about like strategy and, position size, portfolio management, etc. So just starting with the flashes right in the beginning. The first one, look for your money where you lost it. Losses are punishment for bad judgment. And I mean, if that's not the truth, I don't know what is. How many times have you made a trade, rushed into a trade, bought something, and then it started going against you, and then next thing you know, you start doing research and you're like, oh man, what was I thinking? The chart looks terrible. Or, oh, they're not even making money. Or, oh man, there's this fundamental is absolutely horrible. Or, oh man, this just happened, etc., etc. And I think that is a perfect example of, basically making bad judgments. So, take the time, put in the work, and then, make the trade or investment or whatever after you do the work. Next one is, are you riding a dead horse? Get off and get on a live one. That is relevant so many different ways. How many times have you been in something and it's just not moving, and then meanwhile, other things in the sector, leaders in that same sector or competitors or whatever are just absolutely crushing it. And instead of switching into something that's killing it, you just sit there and say, when's going to be my time? And I think that's perfect example with cryptocurrency in general, with things like XRP or something like that, where you're just holding on to a bag, or you're holding on to second best or third best or 10th best. And meanwhile, everything else is just outperforming, and you're just too stubborn to just get on the winner, get with the winner. When you go to a horse race, you don't just keep betting on the one that gets last place, hoping that eventually it gets first place. No, you just bet on the guy that's going to win the most amount of time. So next one is, I'm going to skip through a couple here and just do a few of the relevant ones. The moment your diagnosis is completed, it becomes a command to trade. And, that's a perfect one as well. Like, what is the point of going through and looking at charts, looking at the time frames, looking at, the technicals and saying, oh man, this doesn't look so good. Well, if you're in that position, you should look at it and say, this doesn't look so good. I'm going to create an invalidation range for this position, or I'm going to just get out of it now and wait for the time to arise to when it does look good again. Instead, you do something and you say, oh man, this doesn't look so good. And then you just sit in that trade and take a loss, or vice versa. You might see something and say, wow, this looks like it's about to break out. Let's see what happens. And then all of a sudden it breaks out and you're like, oh, why didn't I take that trade? That was stupid. Well, what's the point of doing all the work? I mean, you don't have to just jump right into it if you're new to the markets or you're still learning or whatever. But, you know, you're never going to really learn if you don't actually like pull the trigger when it's time, one way or the other. Next one, and we'll just do a few of these, and then I'm going to go into some other stuff, and then we'll do our traditional technical analysis. This is a great one. Little out of date, but would you step into the ring with Gene Tunney without taking a boxing lesson? You know, you could say Mike Tyson, you could say Evander Holyfield, you could say, you know, Conor McGregor, Dustin Poirier. You could make it relevant. But the point is, you know, take the time to actually put in the work. Like I always talk about, invest in yourself. And that's a perfect example of it. You know, you're not going to literally go and get into a boxing match with somebody if you never took a boxing lesson. No, you're going to put in the time, you're going to put in the work, you're going to put in the blood, the sweat, the tears, and then you're going to go out there and you're going to box your heart out. And then if you win, you're going to be proud of yourself because you put in the work. And if you lose, you're going to know like, okay, I legitimately put in the effort. I can get better. If I want to keep doing this, I can do it. But I know that I at least put in the work. I didn't just go out there and get lucky, throw one punch and knock somebody out with a lucky punch. And, you know, that's it. Because then you're not going to appreciate it. You're going to think you're a genius. And that's just not how you're going to be successful in time. Eventually you're going to run into somebody who's not just going to get hit with that one random punch. Or eventually you're going to end up in a trade that you don't just get lucky on. And that's extremely relevant in the last year when literally everything has just been going parabolic, basically. Next one, a stop order a few points away is insurance against a large loss in case you are wrong. And that goes straight along with my trading strategy. You know, I talk about this type of thing all the time. You know, the key to winning over time is taking small losses and making big gains. And then in the middle, you can just break even on stuff. But if you know, there's really only, you know, a few situations that can happen. You can either take a small loss or you can take a big loss. You can make a small gain or you can make a big gain. Or, you know, you can basically just waste time in a trade and make no money. So if you can eliminate one of those things, which is large losses, well, that only leads small losses and small gains, which balance each other out, flat trades, which again, is just nothing, and then big gains. So that's, you know, that's your winners. Let your winners ride and cut your losers short. Do not operate for the sake of making trades, but only for the purpose of making money. That's another perfect one too. You know, I talk about it all the time. Sometimes I'll go days, even a week, I won't make a single trade. I might, you know, look at some things, but I might not actually pull the trigger. And, you know, that's okay. I don't just make trades to make trades. I don't feel guilty if I didn't make a certain number of trades in a day or a week or whatever. You know, if they're not there, if the easy trades aren't presenting themselves, I won't take the trades. I'm not in it to make a bunch of trades. I'm not in it to make a bunch of calls that are right. I'm in this game to make money, whether it's trading or investing or whatever. I'm looking to make money. And if I don't see the opportunity, I'm not just going to pull the trigger for the hell of it just to make a trade. We'll just do a couple more and then we'll move on to something else. The best way to have lots of money with which to buy bargains in slumps and depressions, sell out in the booms. I mean, that is a absolute most relevant thing you could probably read right now. You know, whether you're a crypto trader, oh, I'm already all in on the markets, but the market's down like 50 to 60%. Well, why didn't you take profits when we ran up 100%, 500%, 1,000%, 10,000%? I mean, there's no excuse for not having taken profits in crypto after some of these cryptos went absolutely parabolic. There is no excuse in something like Tesla or some of these tech stocks or whatever that went down 50, 60, you know, +% from their highs to not be able to reload with twice as many, you know, stocks at the bottom after they sold off 50%. There's absolutely no reason. You know, it's greed. That's exactly what it is. You know, so it's very important to take profits along the way. And, you know, anytime you log a gain, that's a win, regardless. But again, you want to let those winners run. But at the same time, you don't want to just get greedy and ride them all the way back down to the bottom. Because then you're not really an investor. You're not really a trader. You're just a hodler. And hodlers, they're losers in the end. Let's be real. Let's do one more and then we'll keep rolling. So actually, there's a couple more on this page and then we'll go keep going. The only fundamental factor that really counts in the stock market is the law of supply and demand. You know, we talk about technicals and why the technicals are so important all the time, and how I really don't care about the fundamentals unless I'm making some long-term investment in something and I want to make sure that it has actual, like, you know, good fundamentals, that I'm not just buying like Dogecoin or AMC or something like that for like a long trade because the chart looks good. You know, the actual only fundamentals that matter are law of supply and demand. Are there more buyers than sellers, and are they sustainable? Is there going to be more buyers in the future? Is this stock going to be more valuable in the future because more people are getting involved in it? Is this crypto going to grow in the future with the network effect, and more people are going to be buying it, therefore the price will go up over time if more people are buying than selling? Other than that, fundamentals are irrelevant. I don't read the news. I don't look at the new things going on. This is exactly what happens. You show me the chart, I'll tell you the news. We talk about that all the time too. You know, how often do we look at a chart or an asset class or whatever, do our technical analysis, and then a day later, a couple days later, a week later, some fundamental news comes out, and then afterwards everyone's like, oh, that's why it dumped. Oh, that's why it's pumped. Oh, that's why this happened. That's why that happened. That's just people looking for a reason, you know, after it already happened. Oh, well, that's why it happened. Oh, well, that makes sense. That explains it. You don't need an explanation. If the chart's telling you something, and then afterwards they say, oh, it's because they got a new deal. Well, somebody probably knew it ahead of time and it was showing itself in the chart. Or the reason it broke out was the chart was telling you it was going to break out, and then afterwards people were just coming up with an excuse why it broke out because they don't understand or don't use technicals. When you realize that you're not beating the game, you have prepared the way for your first step in learning how to beat it. And that's a perfect, if you don't realize you're not winning or you're losing or whatever, how are you ever going to become a winner? Because you have to identify why you're not winning or that you're not winning. And then you can take those steps. Then you can correct those problems. It's like 12-step program for like alcoholics or drug addicts or whatever. You know, you got to admit that you have a problem first, and then you can fix the problem. But if you just sit here in denial and say, oh, I just got lucky, you know, diamond hands, you're never going to be a winner. Maybe for a little bit, but never sustainably over time. We'll do one more and then we're done for today. So this is another perfect one I talk about all the time, and this is probably the most relevant one right now. It is better to be out of the market for a week or a month than to make one wrong trade. Stay out and your judgment will clarify. And that is a perfect one to end on today. And that is probably the most relevant one right now. You know, there's a ton of stuff in these charts, in these markets all over the place, telling us that a lot of these things have probably already or are likely to be topping out here. So, you know, that's why I've been saying lately, you know, I'm just kind of sitting back right now and letting things develop. I'm not going to sit here and call the market to the day, you know, and then every day I have to be wrong until it tops out, or call the bottom to the day, and every day I have to be wrong until it finally bottoms out. No, I'm not going to do that. But I'm going to tell you what I'm seeing on these charts, you know, short term, midterm, long term. And oftentimes, more often than not, you know, you're right. You just have to be patient. How many times have you sat back and waited for something and waited for something and waited for something, and then finally say, oh, screw it, I give up. And then all of a sudden it happens. And you're like, oh my gosh, are you serious? I just bought the top. Oh, I just sold the bottom. Oh, I just, you know, walked away right as the ice cream truck showed up. Whatever it is, whatever the example is. You know, how many times does that happen? That's that capitulation event where you finally give up, and then you give up at the absolute worst time. So that's just a couple of little excerpts from this book. If you have never read this book before, I highly recommend it. I mean, it's like a $15 book. It's like 100 pages, and it is absolutely phenomenal. It's full of amazing articles, stories, everything. Again, it is called Stock Market Technique #1 by Richard D. Wyckoff. And, you know, obviously everyone knows who Wyckoff is now, but I wonder how many people that are talking about him have ever read this book. So, but yeah, I just wanted to do a little something different today. I just wanted to talk about that. I get a lot of people ask me about like what are good books to read for psychology or for trading or for investing or to learn about this, that, and the other. And that is one of my like top all-time favorite books. So yeah, I'm going to see what's going on here. What up, my man? Trader Billy, good to see you. Our Kits, good to see you as well, my man. Breaks 212, good evening. What indicator are you using with the trends with the green dots and red dots? Please answer. Pray hands. That is the parabolic SAR with binary pivots, is what you're talking about. I haven't actually published this version of the indicator, but essentially all it is it's my series of moving averages based on pretty much Fibonacci numbers. And then it has built into it parabolic SAR, which is the red and green dots, and then the binary pivots, which are the blue and purple dots. Matter of fact, we can take a look at them just for a moment here, and I can kind of tell you about what's going on with this one specifically. So essentially the way this indicator is designed, it has a bunch of different things built into it. So we'll start with the dots here. The purple dots at the top and the blue dots at the bottom essentially just create like support and resistance zones. So once you have a peak high, it will create those purple dots. And then once you have a peak low, it will leave behind those blue dots. And then over time, they will essentially draw down towards the price. But they basically put in like support and resistance areas. And then the parabolic SAR, which is the red and green dots, tells you like the overall trend. So it basically is stop and reverse points. Once you take out that, it's essentially telling you like that trend has reversed on that time frame that you're looking at. So you'll notice here, once we take out well, we can start right here. We have this green trend going up. We're obviously in an uptrend, and it gets closer and closer to price as it goes. So that's why it's considered parabolic, is the formula brings it closer and closer to price. So it has to accelerate away from the dots, or eventually the dots will interact with price, and then the trend will flip. And then you'll notice it flips over red here, and the same thing happens again. And then eventually we go sideways long enough that we take out the red dot, and then we go back into an uptrend. So in this case, I'm looking at the gold chart on the daily, and that's telling us we're in at least a daily short-term uptrend. You have to keep in mind, though, that on a daily trend like this, if we're looking at a daily chart like this, these parabolic SARs are going to give you, the green and red dots are going to give you a lot of chop and a lot of different moves inside what is the overall predominant trend on that time frame. So they're a little more functional for like scalping on shorter time frames than something like moving average crosses, which are like a lagging indicator. So also built into this, that's like the two first parts of the indicator. And then also built into this is obviously our moving averages. So in this case, what I use for my moving averages is different than everyone else. I use Fibonacci numbers primarily. So I have the red is the 8 exponential moving average. The yellow is the 21 exponential moving average. And then I use the 821 cross for the trend on whatever time frame I'm looking at. So when we cross through the 8 and 21, you'll notice that we get like a capitulation move immediately afterwards. And again here, as we get the cross of the 8 and 21 to the upside, we get a nice powerful move back to the upside. Again, that's more of like a micro move inside of the overall predominant trend on that time frame. And then also I use the 50 simple moving average here in green, and the 200 simple moving average is the like sort of like faded blue one. I use those because that's what traditional technical analysts use. So like exponential moving averages are better when things are moving like faster, or you're having like big moves in one direction or the other, like percentage gains, as opposed to just like a couple dollars here and there. As opposed to like traditional markets, most like old school stock traders or investors or whatever will use the 50 simple and the 200 simple. So then also, again, back to the exponentials and, you know, our fib numbers basically, the 55 exponential, again, that's a Fibonacci number. That's our bright green one here. And then I use the 200 exponential here just because it basically moves a little quicker than the 200 simple. So a lot of times you'll see what you want to see a little more accurately with that. But having both of them there always keeps your perspective. And then the last one that I skipped over here is the 89 in purple. Sometimes you'll see the 34 on my chart also. That I'll put that one in orange. But I don't use that one nearly as much. But the 89 is really good also. Again, traditional investors will typically use like the 100 simple moving average. I prefer the 89 exponential. So, and then last but not least, you'll see the long-term moving averages down here. The gray one is the 377 and the white one is the 528. I've seen a couple people use the 377 before. I've never seen anyone use the 528. But essentially the idea with Fibonacci numbers is they're divisible by like different time frames. Hence, they like become more useful. So if you look at something like, you know, the divisibility of something, and then you multiply it by that moving average or divide it by that moving average or whatever on a different time frame, it'll be evident. So like if you have a 200 moving average, say, and then you're looking at like a 4-hour time frame, your 200 on the 4-hour, well, if you divide that by 4, it's going to be your 50 on the 1-hour. So, or no, the other way around. Sorry. Wait. The 200 on the 1-hour is going to be your 50 on the 4-hour. And a lot, you know, typically, what are you going to be dividing by? Well, if it's 1 hour or 4-hour or 15 minutes or an hour, that's your 4 multiplier or divider. And then typically like 6, if you're going like how many 4-hour candles are in a day, it'd be 6. If you're talking about how many days are in a week, it's 7. If you're talking about how many, you know, weeks are in a month, you're back to the 4 again, basically. And then if you're talking about like how many months are in a year, you know, obviously that's longer time frame stuff, but that's kind of the actual indicator why I use it and, you know, why it's so useful. So, I have a similar one, that is published that you can use. And again, it's all like down in the video notes. So, but I have not published this one, have not gotten around to it. And, me and TradingView don't always get along. I've had some issues with them in the past. So, okay. So yeah, that's pretty good for the indicator, touching on that a little bit. Hope that helps, my dude. And then, maybe one day I will publish it. I mean, I could publish it right now if I wanted to, but I'm sort of like boycotting TradingView because I had some issues with them in the past. And you know, once you publish something on TradingView, if you publish it like privately, people are not supposed to be able to access the code. And I've had issues in the past where I have published things and then all of a sudden my exact code was like mysteriously in other places. So, and I know it has to do with someone that was either working for them or moderating for them or something like that, was doing some dirty stuff. So, but anyway, so yeah, let's get into our technicals here for a minute, and then we will jump back into like a little like knowledge bomb that I'm gonna drop just on like some stuff that was asked specifically in the trade group. So let's talk about 10-year treasury first, TNX. Obviously, we are above our moving averages here. We have been, you know, we've gone into great detail with this. We've been below our 200 exponential and simple moving average since December of 2018. You'll notice the 2 blue moving averages here. And now for the first time in a long time, we now have the 200 exponential and simple moving average angled to the upside here, which means the dollar is in or the DXY rather. I'm sorry, the 10-year TNX is in an uptrend now. Once we are above them and they're sloped to the upside, that is considered to be like my validator for a long-term positive trend. We have come back down to check them for support, and they are currently holding. I do expect this to kind of chop sideways for a little bit, but you'll see now that we were above the 377 and 528. Now we're kind of in this little cluster right here. We are getting the hard buy signal. We do have multiple green histograms in a row. So, you know, on the daily time frame, this is telling us that the 10-year treasury note will probably be, or the interest rate rather, will probably be headed back to the upside sometime in the near future here. So, but we do expect a little chop in the meantime. So, oh, you know what? I was wondering why that looked a little different there. Yeah. So that was our daily time frame right there. Now we look at the weekly here. The weekly, we have come up. We've been in a long-term downtrend since we broke down from it in April of 2019. And now the 821 is the indicator that we're now potentially entering into an uptrend. We got the 821 cross to the upside, but ran into the 200 exponential moving average, and that was acting as resistance. And now it looks like we're about to get the 821 cross back to the downside, which would tell us that we're either going to go into a consolidation or short-term downtrend at least. So here on the weekly, we also have the hard sell signal leaving the bullish control zone. We're now inside the bearish control zone, and we have all red histograms in a row, and we are now below the slope line. So what is that telling us? It's telling us more likely than not, we're going to be in a sideways consolidation, or at least a medium-term downtrend again, while basically this price action resets. So, you know, the yields, everyone was talking about how the yields were going to stay at 0 forever, and then they started shooting up all of a sudden, and then everybody's calling for like 2 and 3 and whatever % yields again. And then of course, you know, we were already topping out at that point in time. So now what we expect is like a sideways consolidation, or, you know, more probably, you know, a sell-off back to one of our key levels, which if we pull up our Fibonacci levels, we can see we take our Fibonacci from the top here in October of 2018 down to the bottom, and then we can check our internal retracement levels of our Fibonacci support. And we'll notice here that the yellow Fibonacci is the one that we just were talking about here. When we came back up initially, we topped out on the 382, came back down, busted through that, and came all the way up above the 618, but we were unable to hold the 618 as support. When we broke down from that, we hit our measured move target perfectly. We also hit our heart line perfectly of our macro channel that we're looking at. And you'll never see this channel on anyone else's chart here. It's basically like a parabola on the bottom and on the top here, and then essentially a heart line in the middle. You can see this goes back, you know, to 1981, how many times we've interacted inside of this area. So to come down perfectly and see how many times we have gotten a reflex rally for support or resistance perfectly on that area throughout this entire trend tells you it's obviously very important. And the amount of times that we have touched the blue support here on the bottom along the way, and how the parabola is interacting, and then again for the red on the top here, and you know how substantial that is. More likely than not, you know, every other time we have come basically from the top to the bottom, to the bottom, to the top, to the bottom. So eventually we would expect us to make our way back up to the top, but we don't expect it to just happen in a single line up here like everyone else was expecting. So now what we're expecting to happen is we came down, we got our measure move of the channel that we broke out of, we hit the heart line perfectly, we got the bounce back up, retested our support area that we broke down from, which we were not surprised. We knew that was going to happen. We retested it as resistance. We got essentially a bearish rejection candle right here. Could we keep going back up to the upside? Sure, we could. But it looks more likely than not. We broke down from this level, got a reflex rally back to the upside. It failed or got pushed back down, and now we would expect to come down lower to our next target, which is going to be our 0.5 Fibonacci, which is somewhere around like 1.13. And then after that, potentially down here to like our 382, which would be the 0.887. You know, 1%, basically less than 1%. And then if we zoom out here again, we can see what's really going on this chart. If we go all the way back to the very beginning, to our, you know, trend, which is obviously a downtrend from the 1980s, we have our top one right here in red, and then again our bottom is the 0 down here in red, and then we can see what our internal retracement is and how many times we bounce on this level throughout the entire range. And we'll notice here that when we came back up off that bottom area, we immediately tested the 236 here. We got rejected and came down. We put in a higher low, telling us that we were signaling an uptrend. And then also we started putting in on shorter time frames bullish divergence, telling us that this had likely bottom. And then when we came up here, we noticed we have a W pattern right here. So when we took out the neckline of the W pattern, we expect to get our measure move here in green, which is the distance from the bottom of the W to the neckline or V of the W. Of course, we got that move and then a little bit more on top of that. We came up and we topped out exactly at the 382. So it would be very likely that we come down to the 0, come up to the 236, then we put in a higher low, then we go to our next fib level, which is the 382, then we come back down and put in a higher low. Is the higher low going to be at the 236 in red here? Is the higher low going to be at the 236 in yellow? Nobody knows. We don't know right now. What we do expect though is that we have a low here, we have a higher low here, and we would expect that somewhere in between where we're at now and that previous low, we would put in another higher low. So, but in the meantime, the bond yields, the interest rate on the bonds looks bearish. Looks like it's going to come back down. It really does. We also ran into a very substantial, you know, we can talk about this a little bit and then we can go to the actual bonds and look at them. And, you know, obviously it's the inverse chart basically. But we have essentially, this is our neckline here, this blue line. We'll make it a little bigger. That's our neckline of what appears to be a inverted head and shoulders pattern. So we have our neckline here. We have our left shoulder. We have our neckline touch again. Then we have our head all the way down here, which is potentially a double bottom situation we just talked about. And then we come all the way back up to our slanted neckline once again. and then we come down, and now we're going to put in our right shoulder somewhere in this range. We want it to be somewhat symmetrical to what we have here. So is it possible we already put it in and now we're going up? It's definitely possible. Would I expect it to come down deeper though, at least to the 0.5 or, you know, potentially the 382? I definitely think so. And then at that point in time, we would expect to rally back up. And if it stays strong enough, we come back up to the neckline. And if we can get a break through the neckline, we would expect to get our measured move of the head and shoulders pattern, which once again is going to be the distance from the neck to the head down here. And, you know, that would basically take us up to the top of the range, which is going to give us a test of the macro pattern that we have here. Maybe it falls a little short at the 886, you know, which is going to correspond with our next Fibonacci level in red as well, which is our 0.5. So, you know, at some point in time, we expect to come back up here, and then we have essentially our target zone here in red, which we would expect to top out somewhere around there. Maybe we overshoot it and come out the top a little bit. We get up to 3%. Maybe we undershoot it and we only get to like 2.2%. But I think somewhere around there, you know, somewhere in this time frame by, you know, mid 2023, a year from now, I think that's realistic. Maybe it happens by the end of the year. Maybe it takes a little bit longer, but somewhere around that range inside that area for our treasury yield. So, and then if we look at, you know, what's going on here, you know, we can see from where we bottomed out here in mid-April of 2020 to where we topped out here, which was basically, you know, beginning of April 2021, it took us about a year to make that move here. So is it unrealistic to think it could take us, you know, another year to get up to the top of the target? I think that's pretty realistic. I mean, from right here, October 2018 to when, you know, we put in our shoulder and then came and broke down from it, that was February 2020. So, you know, it's not unrealistic to think that that could take us a little over a year to fill out the rest of this pattern and make it up to like that 2 to 3 range. So. And then finally, if we just go to a slightly longer time frame, we'll look at our monthly chart. And we're just going to pay attention to our indicators here, not as much our drawing tools, and then also obviously our moving averages. We'll notice a couple important things are happening here on the monthly. Let's start down here with the TJD, TDMACD. And these indicators are just about all the rest of them are available free too on TradingView. A couple of them are just a little bit older versions that I haven't updated, but you can find just about everything for free on TradingView, and it's all down in the description. If you've never gotten these indicators, I highly recommend it. They're phenomenal. They're easy to use, easy to learn, and they work extremely well. And also I have the indicator series, which is a playlist on the channel as well, so you can kind of learn. I need to update them because some of them are a little older, but you can get the gist at least. But you'll see once we have 2 green histograms right here, that's extremely bullish. We come out, we get above our red slope line here. That's our second signal on this indicator. The third signal will be if we stay above this red line long enough, it will flip over blue and the slope will be positive. And that's all 3 portions of this indicator giving us bullishness. And then you'll notice here, we're inside the bearish control zone. We get the hard buy signal in bright green right here. And then we exit the bearish control zone. So that's 1 signal, that's 2 signals. And now if we get up here long enough, we would expect the background to turn red. And that would be us inside of the bullish control zone. And that is our third and final indicator of the bullishness of, you know, the overall trend. And then if we look right here as well on the actual chart itself, and we look at the prophecy, you will notice that we have flipped over our green parabolic SAR, giving us an uptrend. We have moved the 8 moving average above the 21, the red above the yellow, giving us once again an uptrend. We then came back down and are retesting it now. So if this area holds right here and we just consolidate or stay around this area roughly, you know, for a couple more weeks, couple months, etc., and then we do find support and move up, we'll get a solid 821 cross to the upside. And then we would expect, you know, we obviously got rejected already on the 55 here. We would expect to move up to the 50 simple and the 89 exponential right here. So again, that's our move up to like the 1.95. And then again, if we consolidate, break through that, we would expect our move up to the 200 exponential and simple, which just so happen to be at the exact same spot, which is right around that 2.8 level. And then the most important thing is to get confluence between all these things, our Fibonacci's, our drawing tools, etc., because that tells us that we have a bunch of things agreeing, you know, on the same situation. So if we turn back on our drawing tools, we can do one final thing, and we can just look how they all correspond together, and we will notice that this neckline right here corresponds perfectly with the 55 where we got rejected. We will notice that, you know, basically this 821 cross right here was exactly at the measured move and lines up with the heart line right here. We would notice that if we do break through this area here, we would run into some resistance at essentially the previous high from our neckline at the 50 simple and 89 exponential. And then finally, if we get our measured move to the upside, we run into the measured move in green here of the entire pattern. We run into the 200 exponential and 200 simple moving average. And then we also run into the top of our macro channel going back for the last 40 years. So that's how we're looking at this. I do expect currently further move. Well, if you look at it right now, short term, we're looking pretty bullish on this. Short term, medium term, we're looking bearish, and long term, we're looking bullish. So what do we expect to happen? We expect some kind of slight move, maybe up here or whatever, and then we expect a downward consolidation, and then finally a strong move to the upside. So, and then if we just switch over to the TLT, which is our 20-year treasury, this is the actual bond, as opposed to what we were just looking at is the yield on the bond. So these charts will trade completely opposite to each other, inverse of each other. We'll notice that we are essentially putting in a macro head and shoulders pattern here, which is obviously the opposite of our inverted head and shoulders on the yield. So even though this is the 20-year instead of the 10-year, just to kind of keep a broader perspective on things, very clearly put in a left shoulder here, very clearly have a neckline here. We bounced, obviously it was resistance here. We got through it, came back down, retested it as support a couple times, put in a higher low here, took off parabolically, came all the way down, retested it again, put in a higher low here, and then we came all the way up and hit perfectly our target for the right shoulder. Could we continue this right shoulder to the upside up to the 0.5 or even as high as the 618? We definitely could, and that would show strength in the pattern, and then we would expect the measure move to the downside to be lesser should the pattern develop. But in this case, we came up perfectly to the 382, which again, if we just look at how we drew that, we took from the head right here and we went down to the neckline right here. Initial move to the upside was a 236 where we consolidated. We got an immediate burst up to the 382. We then came back down and consolidated. And then, next target would be the 0.5 to the upside, which would be basically $154 on the bonds or potentially as high as $160. And then if we just zoom out here and we go to, we'll notice here actually before I zoom out while I'm on this time frame, let's look at what's going on. So we're finding resistance at the 377, the 528, the 200 exponential, and 200 simple moving average. So that's going to be a difficult area to get through, but if we hang out here long enough, we'll break through it, and it will basically just be our previous highs we'll have to worry about as resistance. But we're very clearly here in a bullish trend based on the blue slope line here. We are very clearly in the bullish control zone, which is the red highlighted area back here. And then we're above all of our moving averages, basically with the exception of the 528 and the 200 simple. But if we hang out here long enough, we'll be above them as well. So now let's zoom out and take a look at our longer time frames here. This is our weekly. And, we'll notice here, obviously, when the 821 crossed back here on the weekly, we then sold off into a powerful downtrend. And now here we are, the 821 have crossed to the upside. We essentially got a rejection candle right here. We then got a rejection of lower prices. So we got a rejection of higher prices, a rejection of lower prices. So that's basically a war taking place to see, are we going to keep going to the upside or are we going to go back to the downside? And we'll notice now on the weekly, we were obviously in a long trend to the upside on this. We obviously have a bunch of green histograms in a row and we're above the slope line now. We notice we're getting the 821 cross to the upside. So of course, this is telling us the exact opposite of what the bond yields are telling us, because obviously they're the opposite of each other. As the prices go up, the yields go down. As the yields go up, the prices go down. And then or the other way around. Here on the monthly, we'll notice that we were overall in a long-term uptrend on this chart. We poked out of the top of our support resistance channel right here, and now here it's telling us the same exact thing, opposite. We maxed out at the very top right here, got the hard sell signal, and then we left the bullish control zone. We are now in a long-term monthly downtrend. We have a bunch of red histograms in a row. We are below the blue slope line. If we hang out here long enough, we would expect that slope line to flip over red. Does that mean we can't have further upside short term? Nope, not at all. Short to medium term, we could definitely continue to the upside, but overall we have crossed 821 to the downside. We're attempting now to cross it back to the upside. I would expect that to get rejected sometime here in the future, this to roll back over at a key fib level, and then we would get the measure move break of the actual pattern here, which again would be from the top of the head to the neckline, which is going to take us down somewhere around our 200 exponential simple moving averages on the monthly, and also the bottom of the channel as well. So that's our technical breakdown of the 10-year treasury yields and the 20-year treasury bond. So, and again, they're always going to trade opposite of each other. Oh, I'm sorry, that's a 20-year bond. But give us the same thing basically. So let's look at the dollar now and see what's going on with that. And then we can talk about the relation between some of these things, and then we'll get into some of our assets as well. So I'm going to turn off the drawing tools again. And once again, we're going to look at the moving averages. We'll notice here that, you know what? Okay, yeah, we'll stay on this time frame for a minute, and then we'll talk a little bit more about it. So we're on the short time frame, the daily right now. We'll notice we've been inside the bullish control zone here. We got the divergence signal, sell, buy, sell. We left the bullish control zone, and then here we are basically just going sideways. We call that a bullish reset. What is taking place right now is the indicator oscillator is now trending to the downside while price action basically goes sideways. We do have to be careful though, because if we'll notice here, we have a high on the indicator oscillator in blue, then we have a lower high here in blue. And then if we go to price action, corresponding with that high, we have a high here on price action, and then we have a higher high here in the actual price action as well, as opposed to our lower high here on the indicator oscillator. So we have to be careful, because that's basically telling us there's bearish divergence taking place. And then we can actually use this third high right here and this third little drive up on the blue right here to give us a third lower high. So we basically have a high, a higher high, and a higher high. We have a low, a lower high, and a lower high. That's 3 drives of bearish divergence, at which point in time we would expect a powerful move to the downside. You know, which you could argue we got some of it already, but I would assume that we're going to get more of it. We'll obviously find support on the 200 exponential and simple and the other cluster of moving averages. But at this point in time, this is telling us sell by sell signal, multiple red histograms in a row. While we're still bullish, we have left the bullish control zone. We've gotten the hard sell. We got the divergence signal. We would expect with this bearish divergence to play out further downside at this point in time. And we'll notice also that, you know, on the same time frame, looking back at a little bit bigger here, we'll notice here on the TJD, TDMACD, our low area right back here corresponds. And then our low area right here as well. You know, we're just looking for the distance down from that. So you'll notice we have a low here, then we have a higher low here. And you'll notice we have a low here and a higher low here. That's what you would expect to see typically with your movements. That's like convergence between the indicator oscillators and price action, as opposed to what's taking place here on the short term, which is divergence, telling us that this trend is unsustainable to the upside, because it's taking us less and less energy, and eventually that has to run out, you know, and then we would expect that downward move. So that's what we're paying attention to right now. And then again, if we just kind of zoom in here, we'll notice we have the high here and we have a lower high here from the 2 peaks. And then on price action, we have a high here and a lower high here on 2 peaks. If this continued back to the upside and then we put in a new high on price action right here without putting in a new high on the indicator oscillator, we would look at that as divergence, but have put in a new high. So we would expect again a powerful sell-off. But right now we have a low and a higher low. Right now we have a high and a lower high. So we have to be careful as to what's happening here. But overall, does look bullish to me. You know, on the short term, it looks a little bit bearish. But if we switch over to our weekly chart, we basically are on the weekly. We have our initial drive down here, which put in a low, and we have a very low on the indicator oscillator. And then here we have a lower low, and then we have a higher low on the indicator oscillator, higher low on the indicator oscillator. And then again here we have a third low, which is the same low. And then we have a much less substantial move on the indicator oscillator. So again, if we look at those, we have a low, a higher low, a higher low. And then here we have a low, a higher low, a higher low. And then here we have a low, a lower low, and the same low. So this is triple bullish divergence taking place on our weekly, which tells us we're likely to get a powerful move to the upside. And then if we look at the DXY, you know, we're obviously getting multiple green histograms in a row. We have now flipped over the slope line blue, and we're above the slope line. So this indicator on the weekly is telling us that the dollar is in a powerful uptrend on the weekly time frame. We have now also left the bearish control zone here, and we got a hard buy signal, which is telling us once again, based on the jewel thief, that we're in a powerful uptrend. And then again, we have the 821 crossing right here, and we're working our way through these moving averages, again telling us the dollar is in a powerful uptrend. But until we get above the 200 exponential and simple moving average, until we get a positive slope on them as well, we cannot consider this to be fully validated on the weekly chart. But typically, once we're in an uptrend, you know, we got above the 200 exponential and simple back here in like 2012, and then we moved up this entire time on the weekly DXY, and then we broke down from it here. So are we going to be able to save this, or are we going to go into a long-term downtrend and this was just a reaction rally? Well, we'll have to wait and see. But you guys know how I feel about the dollar. So and then if we switch here to the monthly, we can get an even more clear picture. Basically, the 200 exponential and simple moving average populated on the monthly back here in 2002. Since that time, the blue moving averages have both had a downward sloping angle, and we have been underneath them with our price action, telling us that we were in a downtrend from July of 2002 until basically, when we got back above them here in February of 2015. So for a 13-year period, we were in a downtrend. Now we have broken above them for the first time in 13 years. We came back down and retested them. And then you'll notice here something has happened that has never happened before on this chart, basically, because it's monthly and only goes back to the 1980s. We are now above our 200 exponential moving average. We're above our 200 simple moving average. The slope line is angled to the upside. The slope line here is angled to the upside. They're sort of flat right now, but they're basically moving to the upside. But essentially what's happening now on the monthly is we're leaving the bearish control zone. We're about to get the hard buy signal, the cross between the blue and purple Stoch. We now have 2 monthly green histograms in a row. So basically, this is telling us that the dollar is likely or has already entered into an uptrend. And, based on the amount of time that we're typically in an uptrend for, we're expecting this to last for multiple years, potentially even a decade. So while the dollar has overall been in a downtrend since the 1980s, we have a high, we have a low, we have a lower high, we have a lower low, we have another lower high. So while we have been in a confirmed monthly downtrend since 1986 on this chart, we are now, for the first time ever, potentially entering into an uptrend. Obviously, we would need to start taking out our previous highs. We would need to start moving to the upside, but that is definitely a possibility that the DXY will actually be strengthening for the first time ever compared to long term, compared to the basket of currencies that's in it. So that's what we're paying attention to. Obviously, seeing some mixed signals again. As short term, we have some bullish signs. Medium term, we would expect this to cool off and go sideways. Bearish signs. Medium term, we would expect this to move potentially to the upside here, but we could have a short-term cooling off. So, and then again, if we just kind of look at, let's turn off the moving averages. And we'll just sort of look at this pattern here. Similar, we have a potential inverted head and shoulders pattern taking place. We have a left shoulder here. Neckline is here in red. We have the head down here. Then we have an interaction with the neckline once again. We have the right shoulder here. And then now here, we're trying to break through our neckline. If we do break through the neckline, we would expect to get the measure move from the head to the neckline. So from down here to the neckline right here, from the breakout point, which would give us a potential move on the dollar back up to 96, 97, which is essentially going to correspond with our previous resistance. As we had a bunch of support through this area, we broke down from that support. We would expect it to act as resistance. And then if we just zoom out on the macro here as well, we can see from the top of this to the bottom right here, first time we came up to the 236, then we put in a higher low. So our next target to the upside would be the 382 at 94.27. After that, we have the 0.5 up here at 95.8, and then potentially as high as the 618 at 97.489. So, but that is our DXY chart and essentially what we're looking at. And now we can see there are definitely some relations taking place between what we're looking at on this DXY chart and what is potentially taking place. There's obviously some differences as well, but we have a potential inverted head and shoulders or double bottom scenario with a bunch of bullish divergence taking place here. And then if we look at, if we look at our 10-year treasury on the monthly as well, we have a potential inverted head and shoulders taking place as well, which would essentially mean that we would get that same move similar to what's taking place on the dollar. So what does that mean? It means if the dollar strengthens and bond yields strengthen, actual bonds are probably going to go down. And that is obviously both those things. Higher interest rates on bonds are going to put pressure on assets. And then also, strengthening dollar is going to put pressure on assets. So both those things would be bearish for asset markets. So And then we can talk about, actually, we'll take a little break from that and talk about like the relationship between some of these things as well, as was requested from the group. So I want to talk about a couple of things that are inside of my strategy. For once, I actually made some notes, so I'm not just going to be ranting off the top of my head, although I do know you guys love that. But essentially, there's a couple key points that I look at. Obviously, I am a technical trader, I am a value investor, and I'm a conservative investor and trader. I look for easy trades that are repeatable, consistent, and have high risk reward ratio. So my three main criteria that I take into account when I'm looking for a trade or an investment, there's a little difference for investment because I will look at fundamentals some. Like I want to see, are you a profitable company? Are you, moving in the right direction if you're not yet profitable? What is your, earnings ratio, price to earnings, or price to sales, I guess, if, depending on what evaluations you're going to use. But essentially what I look for is three main things. I pay attention to my position sizing. So essentially I want to divide my account up into however many trades, assets, or asset classes I want to be involved in. So if, say, I want to be involved in the 11 sectors that make up the stock market, or you can narrow those down into a couple that overlap, and then say you want to be in precious metals as well, or commodities, and then you could say that you want to have a position in cash potentially as well. So you end up with, like, say, somewhere in between like 10 and 13 to 15 different things if you want to count foreign investments or whatever. So you want to divide up your investments, into 10 to 15 different portions. And maybe some are going to be bigger than others. Maybe some are going to be more heavy weighted than others. But, essentially, if you have a, $100 and you want to divide it up between 10 asset classes, maybe you want to put $10 in each asset class. Maybe you want to put 20 in one and 5 in another, because you want one to be more heavily weighted than the other. But by identifying that, or say you just want to have your short-term trading account and you want to be able to make 10 trades at a time. So you divide it up into 10 portions and then you make equal portion trades in them. So that's your position sizing. And then if you take 10% of your trading account and you use a 10% stop loss, that every time your stop loss gets hit, you're going to lose 1%. Every time you make 10%, your whole account's going to go up by 1%. And that's, essentially how I do position sizing. There's different weights for different things based on, like, overlying market trends, what I expect to happen, uncertainty in the market. Are we going into an inflationary environment? Are we going into a deflationary environment? Am I risk on? Am I risk off? Etc. So the next portion of, my trading plan and what I pay attention to is probability. What is the probability of success when you take a trade? And how can I influence that probability? Well, if I flip a coin, what is the probability of heads or tails? It's 50%. It's 1-to-1 ratio. There's an even chance whether it goes heads or tails, irrelevant of whether it went heads or tails the time before it. It could literally go heads 300 times in a row, and that does not increase the probability of tails coming up the next time. It's still 50-50 every time. So if the probabilities that you're paying attention to are the price action either goes up, price action goes down, or potentially goes sideways so long that eventually you lose the trade because you were in it so long sideways that you give up, or you're using options so you have time decay, etc. So there's technically 3 possibilities, but if you take time out of it, you just have up and down. So it's a 50% probability. So how can we influence the probability of that happening, and how is probability relevant? Well, we got to identify a market edge. What is our edge on the market? How do we gain an advantage over the market so it's no longer a 50% chance of success? Well, one thing I like to do is identify the predominant trend or the time frame that I'll be trading on, and figure out, are we in an uptrend? Because if we're in an uptrend, that means we're consistently making higher highs and higher lows. If we're in a downtrend, we're consistently making lower highs and lower lows. So that tells me that if I want to take a long, I want to be in a bullish trend, and I have a higher probability of success, or I have an edge over the market because the market is predominantly going up. It's like a stair step up. It goes up 2 steps, then it goes down 1 step, then up 2 steps, then down 1 step. And that's essentially the idea of putting in higher highs and higher lows. So if I trade to the upside, if I take longs, or buy call options to the upside, I'm more likely going to succeed than that 50% because predominantly the trend is up. The same way that if we're in a downtrend, we take 2 steps down, then we get a dead cat bounce back up 1 step, then we take another 2 steps down, then we take 1 step back up. I don't want to be taking longs in that predominant trend, unless it's just a quick little scalp. I want to trade with the trend. So I want to either be flat in those markets and wait for it to bottom. I want to take shorts in the markets. I want to, sell calls or buy puts, whatever the situation is. But I want to trade with the trend because I expect that over a long enough time frame, the probability is, the edge is that we're going down. So we're going to continue going down. And it's only going to reverse back to the upside one time permanently. And then at that point in time, if we can identify that the trend has changed and we're now back in an uptrend, then we want to be able to transition over and start making, bullish trades or longs. So that's essentially probability. And a good example of that is if you look at probability and you say, if I flip a coin, there's a 50% chance I get heads, 50% chance I get tails. But there's also like that small probability that the coin falls on the ground and I can't find it or I have to go looking for it or whatever. So, there is always like that little X factor outside of it. But a perfect example is, okay, if you say, I don't have any food, I need to get food. So I'm either going to die if I don't get food because there's no food, or I can go to the grocery store and get food. But there's a chance that if I go to the grocery store, I could still die. Because if I get in my car and drive to the grocery store, I might get in a fatal accident and die. But what is the probability of me dying if I don't go get food? Well, it's 100%. If I don't have any food, eventually I'll die. It's a fact. 100% probability I'll die. If I get in my car and I drive to the grocery store, there is still a chance I could die. There's still a probability that I can die. But what is the probability? It's like 0.001%. It's like 1 in like a million times you go to the grocery store, someone dies. So the probability, is that if I go to the grocery store, I have a way better chance of living than if I stay home and don't have any food and I just automatically die. So that's a good way to look at like extremes of probability. But we don't need it to be extreme like that. We just need it to be a little better than 50% so we can win over time. And then once you have those two things mastered, the next is risk management. Risk management is huge because it's like we talked about in the beginning of the video. We want to cut our losses short and we want to let our gains, our winners run. And then that way, our small losses and our small gains cancel each other out. If we lose 1% and we gain 1%, on an equal dollar trade, they cancel each other out. If we, lose on what would be a big loser, but we cut it short at say 5%, we lose 5% on that trade. But if we have a winner that runs 20% or 50% or 100%, we can then take the 1% winner and the 1% loser and they cancel each other out. We can then take the 5% loser and then we can counteract that with our 20% winner or our 50% winner or our 100% winner. And if we just flip that coin enough times and we, are right enough times without an edge on the market, eventually we will win. And naturally, things are biased to go to the upside. It's a common misconception that, if you lose 10% and you gain 10%, you're right back where you started. Well, that's not true. You actually have to gain slightly more once you take a loss. So if you start with $100 and then let's say we lose $50 of that $100, we're now down 50%. So now we just need to make 50% back. So all we have to do is go back up 50% and we're back to even. Well, no, that's not correct. If we have $100 and we lose 50%, we now only have $50. So with that same $50, if the price goes back up 50%, we now only have $75. So we actually, if we lose 50% of our trade or of our portfolio or of our investment, we now need to make back 100%. Because if we go from 100 to 50, we now need 100% gain to the upside, which would take us back from 50 back to 100. So if we lose 50, we need 100% winner afterwards to get right back where we started. And it works both ways too. If we go, from 100 and then we go up 50% and we get to $150 and then we lose 50% on top of that, well, we didn't just go back to 100. We went from 150 minus 50% back to 75 now. So we're actually worse off. We had a 50% winner and a 50% loser, and we're worse off than when we started. So in either one of those situations, the most important thing is to protect our principal, because losses hurt you way worse than wins help you if we're talking about equal percentages. So that's why it's so important to lose small and win big. And then we can have, everything else will balance out over time. And as long as we're not just losing more consistently, as long as we're not taking things that have a poor probability of playing out, if we just have that coin flip and every time I win. If you and I sit down at a table and we each have $100 and you say, every time you win the coin flip, I will give you $1. And I say, every time you win the coin flip, I will give you $2. And we sit there and flip that coin. The first time you're right, you get 2 of my dollars. And then the next time you're wrong, I get 1 of your dollars. I'm still down $1. And then we flip it again, and you're right this time, you get 2 of my dollars. And then I'm wrong the next time. I'm right the next time, you give me back 1 of those dollars. If we do that 100 times, at the end, you're going to end up with more than I had. And that's because you're using proper risk management. You're having equal probability of success, but you're winning more when you win and you're losing less when you lose. And that's why risk reward is so important. That is a 2-to-1 risk reward. If we have a situation where we have a 3-to-1, which is like the minimum trade that I will take, when I'm looking for trade setups. If we have a 3-to-1 risk reward, that means that every time you're right, you get $3, and every time I'm right, I get 1 of your dollars. And again, the higher the risk reward is, the higher the reward compared to the risk is, the better you're going to do. And then if we flip that coin 50 times in a row and it's even otherwise, you're going to win even more. And then if you put your edge on top of it and use correct position sizing, probability, risk management, risk reward, you trade with the trend, you get your edge on the market, eventually you're going to succeed over and over again, and you're going to do better and better. And that's the thing that a lot of people forget or don't realize, that this is not a game. It can seem like a game sometimes. It can feel like a game. It can be fun for sure. But in the end, there's mentality or psychology affiliated with it. But in the end, it's a science. Trading is a science. It's an art form, combination of the two. So, but the most important things, in my opinion, trade based on technicals. Make sure that you have a trading plan or style that is repeatable, it's profitable, and most importantly, that you're protecting your principal. So with that, I'm going to take a short break, get a quick drink here, and then I want to talk about balancing our portfolio for potential situations that are happening. There is a huge argument right now for inflation. Everyone's talking about the inflation taking place. There's a huge argument, it's much smaller, but it's starting to get a little louder. People talking about deflation and how to hedge for that. And then finally, we have our third possibility, which is uncertainty or collapse or whatever you want to call it, or just who knows. So we'll talk a little bit about that. I have some more notes here, and then we'll get into the actual technical analysis. But more importantly than anything, I just want to make sure that everyone's getting something useful out of the stream, not just the regular technical analysis of all these assets, but the relationship and the importance of balancing our portfolio, knowing how we're going to win if we're right, how we're going to win if we're wrong, and then how we're going to win if, there's uncertainty. So I'll take a quick break, and I will be back in a couple minutes. So not long. You guys know I keep it pretty quick. So. All right, let's jump back into it here. Make sure that you guys are remembering to like and subscribe if you have not already. And also just a reminder, welcome back to the channel, but this is not financial advice. I am not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. He said play some music. I don't think YouTube would like it too much if I play any music. So yeah. Next thing I want to talk about is essentially how to build a portfolio that is hedged, or how to hedge in these different environments. So there's obviously a big scare right now. Everyone is worried about inflation except for the Federal Reserve. Also, we're starting to hear more talks of deflation. You guys, most of you probably know how I feel. We're in a macro deflationary environment. There's a bunch of deflationary things going on. Including technology itself is inherently deflationary. Declining birth rates are deflationary. There's a ton of deflationary things. Obviously, what happened with CVD, the whole big deal, the Fed and all this money printing, all these central banks and all this monetary policy and all this fiscal policy and everything is essentially just attempting to reflate the bubble, which again, the bubble is deflating and they're just attempting to reflate it. In some cases, we've reflated it bigger than it was to begin with. And that's where the scare comes in that it might pop. So if we're right and we see macro deflation or a series of, potential, economic downturns, United States, Europe, China, worldwide, that would essentially look like a series of recessions and potentially a depression, as many people are calling for. And then obviously we could just go into a long-term inflation, or, based on your measurement and what you're measuring, we could potentially go into a hyperinflationary environment. So what are, the risks? How do we hedge that? How do we have a portfolio that's protected either way? How do we make sure that if we're right, we make money? How do we make sure that if we're wrong, we make money? And how do we make sure that regardless of whether or not we're, making money, that we're protected and we can still sustain, our life how it is, a quality of life, and then also, protect our family, etc. So, naturally in inflation, obviously everyone knows there's a bunch of different types of inflation. You can have everything from, what people measure. People say, well, inflation is increase of the money supply. Correct. That is one type of inflation. Most sustained actual inflation takes place because of wage inflation. If everybody, including the people on the bottom, are making more money, then things tend to get more expensive because the input costs to make all those goods that everyone's buying go up, because companies that make cheap products or necessities or whatever have higher input costs. Therefore, they have to pay people more. All their, say the food that they use to make a burger at McDonald's goes up. McDonald's probably going to pass that on to you. Say the cost to pay an employee at McDonald's goes up. McDonald's going to pass that on to you. So they're just going to take however many Whoppers they sell or however much food they sell, and then they're just going to, if their costs go up by 4%, because that's how much more it costs to pay people and get their, ingredients and whatnot, they're just going to charge an extra 4% for everything on the menu, or 10%, or whatever it is. So that is the most sticky type of inflation. When the people on the bottom, when you see wage inflation, like the minimum wages that people are earning goes up, and I'm not arguing this is a bad thing. I'm not saying it's bad to pay people on the bottom more, but that is what causes sticky inflation. So, in the United States, there's a big push for $15 minimum wage for all, universal health care, universal income, all this different stuff. Well, often what happens is if your wages go up by 10%, usually inflation mitigates that and then some. And then you actually see price inflation go up by like 12% or 15%. So while you think you're getting more money, you're actually net losing because you can buy less goods and services with the total amount of money you make in the end. So that's where the real danger comes from, is wage inflation. The other types of inflation are much less dangerous. It's bad if they inflate the money supply. Oh no, they made more dollars, so now there's more dollars in the system. Well, yeah, that's definitely not good. It takes away from the buying power of your dollars, but it doesn't necessarily aggressively attack the spending power of your dollar proportionately the same way. Like M1 money supply is, if you're playing a game of Monopoly and you count up all the bills in that game of Monopoly, there's 4 of us playing, and you count up all the dollars that are in that game and say there's $100. And then all of a sudden you're like, oh, well, I'm going to, print 25% more currency supply in the game. And you're like, oh, okay, so now there's $125. So if everything else stays the same, we now get to buy the same amount of goods, but we all have an extra, if it's divided up evenly, we all have an extra, $6.50 to spend. So that's great because we have more money now to buy more stuff. Well, what happens then is it drives up the prices of all that stuff because there's going to be the same amount of stuff for sale, but there's more money now. So you have to be careful how you look at inflation, but essentially it's a tax, and then not to mention all the like hidden stuff that goes on here too. Like, if the government takes, let's say 25% of your income, and then, you're in like a tiered system, and then all of a sudden now you're making over that next income threshold. Maybe you're making an extra, $10,000 a year, but now that $10,000 is getting taxed at 35% instead of 25%. So in all reality, you would now give up an extra $2,500 on that extra $10,000, but now really you're gonna have to give up an extra $3,500. So you're making $10,000 more dollars, but you still have to pay out your $2,500 in taxes on addition to that $10,000 that you made. So really you end up with $7,500, but then it pushes you up into a higher tax bracket. So now in all actuality, you really made $6,500. So you better make sure that to buy all the same stuff, it only costs you $6,500, or you ended up as a net negative. So that's the problem with inflation. And, houses become more expensive. Same thing with the monopoly thing. If there's only so many dollars in the game and you want to buy a house and there's only so many houses, and, normally, I can't remember what the prices are. I think a house is $50 and a hotel is $100. Well, if there's only so many houses and you're not allowed to proxy anything else in, and they're not building any new houses, well, if you want to buy a house now, you have to buy it from somebody else who already has it. Well, maybe they're going to be like, no, I don't want to sell my house. And you're like, come on, man, I'll give you $50 for it. You're like, no, I paid $50 for it. I don't want to sell it. I'll just keep it for $50. And you go, okay, well, I'll give you $100 for it. And they're like, oh, $100? Well, for $100, I'll sell it for $100. Then I make $50 and then I can turn around and go buy a hotel. But then all of a sudden I go to buy a hotel and I got to buy that from somebody else. And now, well, I'm not going to sell you my hotel for $100, especially because I know you just got a house, $100 for your house. So $200 if you want to buy my hotel. So then you end up with, basically like hyperinflation loop because there's no new goods or services, but there's new like dollars in the system, or less goods and services, etc. So that's kind of how like the argument with inflation is, and why the mentality behind it is that if everything's going to cost more in the future, well, I should just buy as much stuff as I can right now that's not going to spoil. I don't want to buy, $1 million worth of like corn and that's like rotting in my yard because I have like upkeep costs and it takes me like my whole entire life to eat it. So that's why people run to things like gold, because you can buy a piece of gold, you can store it in, a hole in the ground or in your safe or whatever, and it could be able to buy that corn that you were going to buy, or buy that toilet paper or whatever it is. And the same way that if you're borrowing money at basically zero or super low interest rates, knowing that there's an average inflation of 5 or 10 or 20% per year, okay, I can borrow $100 from you now, and I have to pay you back that $100 over 10 years. So I give you $10 a year. Well, if there's 10% inflation per year, then the buying power of those actual dollars goes down. By the time I pay you that last $10, say now you can go to the store and you can get, 10 candy bars for $10. Well, 10 years from now, by the time inflation goes up 10% or whatever, one candy bar might cost $10. So if I paid you back $10 per year for the next 10 years, by the time you get that last $10 back, it's the equivalent of me giving you $1. So I deflated away my debt basically, which is the argument for deflation and why central banks, quote unquote, want inflation, why they want that 2% inflation rate. They're essentially paying back future debt with less money. It might be monetarily the same amount of money that they agree on. They might be paying it back to you with interest, but the purchasing power of those dollars is depleted through the inflation. Therefore, they're actually getting rid of the debt without having to increase the other factors. And then obviously there's a million other factors, etc. So deflation is obviously the opposite of that. So what's the argument behind deflation? Well, not everything is just automatically going to be cheaper in the future, but like technology is inherently deflationary. So like, back in the day when a computer first came out, it was like $10,000 for some horrible computer that barely did anything. Or you could buy whatever, an Atari, and you play like Tetris on it, and that was like amazing, and it was $300. Well, now if you go to the store and buy a PlayStation and it's $300 or $500 or whatever dollars, think about how much better games you get on it. If you buy a phone, a house phone back in the day for $25, yeah, that's great. It was $25 for this house phone. But now you might pay more for a phone, but you get a cell phone, and now your cell phone might cost $1,000, but it has a computer in it. It has internet built into it. It has, all these different things that are built inside of it as well. So the actual technology itself is deflationary. It makes most things cost less in the future because technology is like innovation and things are getting better. So even if they cost monetarily like dollars more, they're like less actual because you get so much more for that same amount or more dollars. So the argument with deflation is that certain things are going to cost less just because technology inherently. But also if there's less people in the future demanding less goods in the future, but there's still the same amount of goods, well, in order for people to sell those goods, there's going to be less demand for them. So if everything else stays the same and demand goes down, well, that's going to drive prices down as well, because otherwise people aren't going to buy it. So the argument with deflation is that if there's 10 people in the world and each of those 10 people has a house, and then one of them wants to sell that house, but then 5 years later there's only going to be 5 people, well, we don't need 10 houses anymore. We only need 5 houses. So in order to get somebody to buy that house, well, I don't need that house. Why would I buy it? Well, I'll give you a good deal on it. Well, how good a deal? It better be real good, because I'm not going to have anybody live in it. So if I'm going to have a second house, I want to make sure it's cheaper. But that doesn't mean that like necessities like food or corn or rice or water or whatever are necessarily going to be cheaper in the future too. But overall, you would expect that goods are going to be cheaper in the future. Real estate's going to be cheaper in the future. Whatever it is, stocks are going to be cheaper in the future. That's the deflationary environment. So if people don't have money to spend on speculative things like stocks or second houses or Ferraris or whatever, then more likely what's going to happen in the future is the prices on those things are going to come down. So that's your 2 worst case scenarios. And then of course you have, uncertainty, where people aren't sure, is there going to be inflation or deflation, but there's like uncertainty in the markets. So people get scared and they run to like safe haven assets or stocks or whatever. So let's talk about how our portfolio can be balanced and how we can protect ourselves in either one of those cases. For an inflation hedge, people typically will run to like gold and precious metals because they can store them and they will retain their buying value. But overall, what they're really doing is, storing commodities. It's just more convenient to do it with gold. The next we have is healthcare. Typically, if things are going to cost more in the future, healthcare is going to cost more in the future. Things are going to be more expensive. Therefore, it drives up the prices of healthcare. So if you look at, what healthcare cost 10 years ago to go to the hospital versus healthcare costs now, it's like 10 times more expensive. Energy is next. Energy is going to cost more in the future because energy is required for everything else. So if everything's going up in price, you would expect energy to go up in price, or energy can oftentimes be the reason things are going up in price. Next, you have real estate. If real estate is, going to be more expensive in the future, people will take loans out with cheap interest rates, and then they'll buy up real estate. And that's why the housing market is booming right now, because there's all this free money out there. So it's like, well, I might as well buy equity, might as well buy a house, and then I can just rent that out, or I can have a second house, or I can sell it in the future because it'll be worth more money, and then I can pay back the loan, and I end up net positive. Next, we have consumer staples in inflation. That's obviously important things. People need stuff like, water or grain or pigs or cows or, whatever necessities are that people would have or want in the future. And then obviously commodities we touched on already. So the opposite is typically the case for gold, or I'm sorry, for deflation rather. You want bonds. You buy bonds in a deflationary environment. The interest rate will be higher typically, as opposed to in a inflationary environment, the interest rates are super low. In a deflationary environment, the interest rates would go up. So the rate you would get paid on your bonds will be better Therefore, people will run to bonds often. Next, we have consumer goods, which is like sort of a overlap there. Defensive stocks, things that are going to like hold their value well. Things like, maybe Apple stock, or, a like, long-term stock, something that's, reliable, been around for a long time, household name, something like, maybe Google or Amazon or something like that, that's going to just do well over time. Sometimes you can look at, more of like traditional old school stocks. Also, ways you can protect yourself from a deflationary environment is to pay off debt. If interest rates are going to go up in the future, you don't want to have a variable interest rate house loan that's going to go higher and higher and higher, and it's harder and harder and harder for you to get money because you're going into a deflationary environment. So wages might be deflating, you're making less money, or maybe it's harder to get income because people are more like, conservative with their spending. And then finally, the last thing you want to do is invest in a home. If you know in the future houses are going to cost less money, why would you buy a house now? I'll just wait. And then when the housing prices come down, once it's deflationary, once there's less demand, once there's more houses on the market, once the dollar value starts dropping, then I'll buy one. But oftentimes that's correlated inversely with interest rates, because again, if the interest rates go up, but the housing prices go down, are you really getting a better deal? So you have to look at how those things measure up against each other as well. And then finally, we have our uncertainty situation, which is basically if you're not sure what's going to happen in the future, is there going to be wars? Is the US dollar going to lose its status as reserve currency? Is nationalism going to become big and people are going to stop free trade with other countries because everybody's just worried about themselves? Is there going to be inflation? Is there going to be deflation? I don't know. I don't know what's going to happen. Is this going to crash? Is that going to go parabolic? Is crypto going to make it? Is crypto going to go parabolic? I don't know. So people will run to cash. People will run to stocks. People will run to bonds. People will run to metals, because they're just not sure what's going to happen. So all four of those, in a nice balanced portfolio, including, having reserve spending power with cash, having stocks in case assets go up, having bonds in case rates go up, or having, metals, obviously, to preserve your buying power. All those things are useful. And then you want to look at, obviously, how can you build a portfolio that benefits from any of those three situations? Well, you got to look for overlap. Which situation, if we have deflation, if we have uncertainty, if we have inflation, if we have uncertainty, what if we have inflation and deflation? What if we have, in some different assets, different markets? So the important thing is the diversity and how to balance it. That way, if we're right, we're not 100% in stocks and we should have been 100% in bonds. But if we're wrong, we're 100% in bonds and we should have been 100% in stocks, et cetera, et cetera. So, think about all the people that have been, 100% in bonds waiting for, the bond rally. And meanwhile, asset prices have gone through the roof this last year. Or think about the people that are 100% in cash waiting for everything to crash down again. And meanwhile, asset prices have gone through the roof. Or the people that sat in gold for the last 6 months, well, it did absolutely nothing or went down. Or the people that, whatever, there's a million different situations, but that's why diversity is, so important in your portfolio. So, but yeah, that's it. I just wanted to talk about a couple of things like that. Some people in the group had specifically asked about it, and I wanted to touch on the relationship between those, how you can protect your portfolio, how you can diversify, and all that good stuff, so that no matter what happens, you're taken care of. So let's get into some actual technical analysis. And again, like always, if you're interested in being part of the group, let me know. You can reach out to me. My email is available on the YouTube page. You just go to the About section. If you've already reached out to me and I have not reached back to you, I'm pretty sure I've gotten back to everybody at this point in time. So just let me know. Also, all the indicators, a bunch of other free tools, including my charts, all available down in the description of the videos. So I highly recommend you go check those out. And yeah, that's it. Oh, before we go here for the next bit, in case you've just come in, make sure you like, subscribe, all that good stuff. Also, remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. All right, so Dow Jones Industrial Average, we are inside the bullish control zone. We are above the slope line. The slope line is green, and we're at all-time highs. We did come back here and get rejected, and now we're showing a little indecision above support. We need to be very careful at these levels. The weekly chart is looking much worse, in my opinion. We have a sell-buy-sell signal. We have exited the bullish control zone. We are still above our moving averages. We are still green on the weekly, but we have all these red histograms in a row, and now the histogram is below the slope line. So that is our first 2 steps telling us this is bearish. We have more than 2 red histograms in a row. We have crossed below the slope line. The next step is if we stay here long enough, this slope line will turn from blue to red, and then we would expect a very powerful bearish move. Where would that take us? Well, we can set out some targets if that occurs. I'm not going to just sit here and start saying that we're going to sell off tomorrow and where we're going, but we have to be very careful as we are showing some clear indecision and potential, for this trend to be topping out in the near future. S&P, we have the SPY here we're going to look at. Very similar. We're inside the bullish control zone. We are potentially about to get the hard sell as the blue crosses below the purple. We're still well inside the bullish control zone, but we're at areas where we have topped out every other time we've come up to these areas. We also have 2 red histograms in a row, including the weekly, assuming the weekly stays like this. And we're definitely showing some bearishness on the daily candles as well, but not quite ready to just get completely scared out of this thing just yet. But we do have to be careful with these indexes, as there's probably about 5 stocks that are holding them all up, as the other 95% of them look terrible. We have at the top of the range, inside the bullish control zone, we just got the hard buy signal, but we have potentially a divergence signal. We have potential for some bearish divergence developing in the chart, but we are able to so far rally and save price. Overall, SPY does not look bad. We're still above all our moving averages. This is probably the strongest of the indexes right now. IXIC, NASDAQ, on the daily, we have an extremely bearish candle after a, basically a bearish candle followed by an extremely bearish candle. So we got essentially a bearish rejection here of higher prices, and then we gapped up, and then we literally just sold off that entire gap up move. Now we've taken out over 50% of the last green candle we can see here. We have the sell by sell signal on the daily. We have multiple red histograms in a row, and we are getting ready to exit the bullish control zone if we sell off any further. So next target would be 14,444. We could very easily just keep going to new highs though. But at this point in time, this definitely looks more bearish. We also have completely bearishly engulfed our previous week's candle, which is obviously bad as well. We are below our slope line. The slope line has flipped over red. We do have green histograms, but we have to be careful that this doesn't just come back up here and put in a high, a lower high, and then a lower high again. And then here we have a high, the same high, and then a higher high, which is bearish divergence on the weekly. And then also here, we have the high right here. Then we have a high, but now we have a higher high. But if we look from this point to this point, we want to make sure that now we have this high, that we want to make sure this high comes up higher, or we will have bearish divergence from this point to this point, as here we'll have a high, and then here we'll have a higher high, here we'll have a high, here we'll potentially have a lower high. So I have to be very careful. The NASDAQ is the most in danger because of super high valuations based on sales or, price to earnings ratio or sales to earnings, however you want to calculate it. But these are extremely speculative, and most of these companies are not profitable, and should interest rates rise, these will be the ones that take the biggest hit. So, and then on the monthly, doesn't look bad. We're at new all-time highs, inside the bullish control zone, all green histograms. So again, I'm not trying to just call the tops on these things. We could easily keep running. The Russell looks the worst. Turn off our drawing tools here. We have gotten basically sold off from the previous high, got rejected 2 times, sold off very bearishly, gapped, basically got to push up, gapped straight back down, got to push up, and then sold that candle off completely, tried to push back up one time, and then broke down from this clear support level that we have here. So now we're down at our next support level here that we're paying attention to. If that level breaks, we have also lost all of our moving averages on the daily. Our next support level would be $2,134. We got the sell by sell signal at the top of the range. We have a very clear double top on the daily right here and rejection of higher prices. And then we have multiple red histograms in a row. This one looks much more bearish based on moving averages. Based on our previous support levels from these 3 touches, I would expect the Russell to come down to like 2100 range, which is where our 200 exponential and simple moving average are if we continue to sell off. And then also we are starting to, for the first time, we got our 821, the red crossed above the yellow back here on June, at the end of June in 2020, and they were crossed to the upside this whole time, and now we have bearishly sold off here. If this weekly ends like this and we have a couple more weeks and we can't come back up to higher prices, this will drag the 821 cross, and then we'll enter into a bearish downtrend based on the weekly 821 cross. We did get the buy signal at the top of the range and then got rejected. So what's going to happen here is this is going to cross back to the downside if we do not immediately rally to the upside, and then we'll immediately get the sell signal right afterwards, and then we'll have the sell by sell at the top of the range. We have all red histograms. We have sold down below the slope line, and the slope line is very, very close to flipping over red. The Russell is by far the worst looking of the indexes we've taken a look at. On the weekly, assuming this weekly monthly just closed right now, which obviously we still have half the month to go. We have bearishly engulfed 1, 2, 3, 4 weeks worth of price action, 4 months worth of price action. So at this point in time, we are back at our February highs. So this is where February's candle closed. We have 4 months of positive price action, and now we have taken them all out in the last 2 weeks. So we are definitely in the danger zone. We're showing weakness. First red bar on the TJD, TDMACD, and we're obviously up in extremely elevated levels, and slope is starting to roll back down to the downside on the stochastics. You guys know what happens if that continues. But again, does not have to be the top, but by far fundamentally and technically the worst of all of the indexes. So this is the XLB, and now we have to be careful with these indexes because of a couple stocks are in multiple of the indexes we just look at. They also have heavy weights. So, you have like your top 5 stocks, big names like Apple, Amazon, Google, Tesla, Netflix, some of these important stocks are basically holding up the entire index. Because of the size of the stock and the weight of the stock inside of that index. Meanwhile, you're getting what looks like good price action, overall or decent price action on the index. But when you look at the individual stocks that make it up, 75% of the stocks look horrible, but the 25 that look good are making the rest of the index look decent still. So we have to be very careful, because if those stocks start to turn, we'll be in big trouble, which we will get into that very shortly with our tech sector. But first, let's look at our XLB. This is the material sector. We have crossed the 821 already to the downside. We are basically putting in a, support line here on the 89, and the longer we hang out at support, the more likely we are to break it. If we do break down from this level, we would expect a retest of the previous high right here, which is going to come in line almost perfectly with our 200 exponential and simple moving averages, around $77.17. We are seeing multiple green histograms. We did get the hard buy signal, but this to me looks like a bearish reset. What is a bearish reset? Well, you can only ever sell off so low down to 0, the same way you can only ever go up so high up to 100. So what happens often is the indicator will sell off powerfully, come all the way down to the bottom of the range, and then you will just go sideways while the indicator oscillators just reset. And then once they have reset back up high enough, they've regained enough energy, refueled, they can start moving back to the downside, and then we can get that next move. But essentially, we just ran out of sellers, but we're not seeing any bullish action while these indicators just float to the upside. The opposite of a bullish reset. And then here on the weekly, you can see we're just hanging out between the 821. If we lose this 21 level, it's going to break down to essentially the same level, which is where our 200s were on the daily, or around that level. And that would be a break of the 21, and then we get the 821 cross to the downside on the weekly. The cross to the upside was back in June of 2020. We've been in a very strong uptrend the entire time since then. We got the hard sell signal. We are barely hanging on to the 21 moving average. We have multiple red histograms in a row, and we have lost the blue slope line. It has flipped over to red. This looks very bearish to me on the weekly. I'm not going to do the monthly, but you can probably figure it out. XLC, our communication service sector. This is, again, we have a very bearish candle where we gapped up and then immediately sold off. That's right after an already indecision or bearish looking candle here. We have left the bullish control zone. We got the hard sell signal. We have 2 red histograms in a row. We have lost our blue slope line on the daily. Again, this looks bearish. It looks like we're getting ready to break down to $81 or potentially $79. Excuse me, I got a little hiccup there. And then here at the top of the range, we have a massive amount of divergence. We're getting basically just chop, 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 chop. Eventually, if we leave the bullish control zone, this could have a violent sell-off. But meanwhile, what's happening? We're floating up on price action while the indicator oscillator trends down. So is it possible this thing just resets and we continue to the upside? Definitely possible. But we do have multiple red histograms in a row. And if we look right here, price action is floating up while we're getting a bunch of, negative signals on this indicator. So you have to be careful on communications, but probably one of the stronger sectors at this point in time. XLE energy. I'm going to turn off all these drawing tools. XLE has crossed 821 to the downside on the daily. We got the hard sell signal. We left the bullish control zone. We have multiple red histograms in a row. We broke below the slope line, and the slope line has flipped over red. Again, this one looks bearish. Could we come back down here to $48 or $47? Looks more likely than not. If we go to the weekly, we'll see a similar thing taking place here. We got the cross back here in November of 2020, and now we have broken down below the 8. We're hanging on to the 21 for now. We have flipped the parabolic SAR over to the downside. We're getting rejected on the 200 exponential and simple. We got the hard sell signal, multiple red histograms in a row. We have to be very careful on the weekly. Next target would be closer to like $47 if this breaks down. If it breaks down. XLF, financial sector, 821 has crossed the downside. We attempted to save it again, failed to do so. We are still crossed the downside. We are still below our moving averages, barely holding on to the 55. We have tested the 89 here twice already. We did put in a higher low, which is good, but financials are not looking great. This looks to me, again, we sold off from the top here bearishly, and then we came all the way back up, but basically just went sideways. So are we just going to continue to the downside? And it's just basically cooling off for now. We'll have to wait and see. But the weekly is starting to look rough as we are closing consistently and getting rejected at the 8. We would expect us to come down here and test this support zone at 35. If that breaks, we could have a very fast move, basically to like below that level or down to like $32. And again, on the weekly, we have the sell buy, sell, exit the bullish control zone, multiple red histograms in a row, getting ready to cross below the slope line. This one is looking very weak. Very weak. Banks are not looking good. Which makes sense because, how do they make their money? They make their money on loans, overdraft fees, interest, all that different stuff. Well, people aren't borrowing loans. Interest rates are extremely low. So they're not making as much money when they do give loans. They're not giving nearly as many loans. People are paying down their debt. It's not, people are having less overdraft fees because people have more money in the bank. So, everything is saying, well, it makes sense that banks would not be doing that great. Although earnings, I think, were overall decent coming in so far. So, XLI, industrial sector, obviously industrials are showing some weakness. We got the 821 cross here. We were able to cross it back to the upside here, but it looks like it's failing now. We'll have to see what happens in the next couple of days. Does it continue? If it does, I think we'll come down here to $100. We have obviously left the bullish control zone. Still have a way before the cross back to the downside, but we are in a very, red slope for a while now. Obviously consolidating sideways to down here. We'll see. Maybe we're just refueling to take back off. But if we continue to show weakness through here, we would eventually expect to test the 21 back down at $100. On the weekly chart, we have left the bullish control zone. We've gotten multiple, signals, sell, buy, sell, buy, sell. We have left it. We have all red histograms on the weekly. This to me looks, bearish. We have broken down from the slope line. That is not what you want to see. Sorry, I had to wet my palette there. All right, so XLK, this is the technology sector, obviously very strong, gapped up here. We are at all-time highs on the daily. We did get sell by sell signal. We're still inside the bullish control zone. We still have blue slope lines. We still have green histograms. Overall, strongest sector of anything we've looked at so far. Obviously, tech is doing well. We have reclaimed the slope line. It has flipped back over blue. We have multiple green histograms in a row, and the bulls are very clearly in control. Technology is by far the strongest right now. XLP, This is our consumer staples. Obviously got a nice move out of this. We did get the 821 cross. We did cross it back to the upside here. We are finding support. We have a bunch of green histograms in a row. Got the hard buy signal. Getting ready to enter into the bullish control zone. If we can maintain this, take out the new all-time high, this thing could definitely run. Consumer staples looking good. Real estate is next. XLRE. Obviously very strong as well. We are up here basically at our all-time highs. We did get a little bit of bearishness come in here, but we were able to essentially not quite bullishly engulf it, but we do want to take out this high on the daily, obviously. This is obviously doing well, especially with all the Fed's $40 billion a month plus in mortgage-backed security purchases. Hard buy signal, bullish control zone, multiple green histograms. Excuse me. We do have to be careful, though, that this is just a bullish reset and we're going to come back up here strong, and that we're not going to end up putting in bearish divergence. But still, time will tell. XLU. XLU has been in this descending channel for quite some time now. It is starting to show a little strength, starting to cross that 821 back to the upside. We really want to see this get up to the top of the range and outside of the range. But we did find support on the 200 exponential and simple moving average. Multiple green histograms in a row. Hard buy, leaving the bearish control zone. Looks decent. Looks decent overall. XLV, healthcare, obviously up at all-time highs on the daily. We are losing strength, though. We are about to get the cross between the stochastics to the downside. Still well inside the bullish control zone, but we do have two daily red histograms, and we were never able to reclaim the slope line. So if we stay up above it long enough, this will flip back over blue, and it could look decent. Maybe we bounce this area and continue to the upside, but we are definitely seeing, a little bit of uncertainty or worry here on the healthcare sector. As typically if we stay above the slope line long enough and we get decent price action to the upside, this should flip over blue. We should be getting strength through this area as we're essentially at all-time highs. So that means there's definitely some indecision in the market. XRT, retail, basically putting in a large ascending triangle. There's a flat resistance here at the top, and we're putting in higher lows consistently. This is a bullish pattern we would expect to break to the upside, but here we're seeing some bearish action the last couple of days here. We did get the hard sell signal, and we are seeing basically what amounts to multiple drives of bearish divergence. We basically have a high, higher high or same 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 high, and then here we have a high, lower high, lower high, lower high, lower high. So that's a bunch of drives of bearish divergence. So, even though we're in a bullish pattern, we need to be very careful that this doesn't get ready and then all of a sudden break out the bottom. So XTN, transportation sector. The transportation sector was operating. It obviously has gotten 821 cross to the downside, which is bearish. It's been operating inside of this channel since our capitulation over a year ago back for the Rona dump. And then here we have broken out of that channel. We operated inside that channel for over a year. So breaking out of it, we would expect to get the measure move, which is the distance from the bottom of the channel to the top of the channel. If we do get that measure move, if we did top out here already, our Fibonacci levels would take us down to the $74 range, or potentially down to the $64 range, or the 0.5 at the $57 range. But we want to be careful. We don't want to get overly bearish on this. Could just have a sideways to downwards consolidation and then another leg higher. But we do expect it to bottom out off of one of these key Fibonacci's if it has topped out. U.S. oil. All right, so we're definitely seeing some uncertainty in oil. Obviously, everything going on with OPEC and whatnot. We were able to take out this high. We got our measure move break of the ascending triangle, bullish pattern. Got the move to the upside, topped out just above that move. Nice profitable move. High risk reward ratio. It was a 4.6% reward, 13.75% or 4.61 ratio with only a 3% stop loss. We knew if we broke down below this level and started taking out our previous lows here, it was bearish. We knew if we got continuation on the breakout, we expected to hit our next Fibonacci extension target, which we did. But now we are seeing some bearishness as we have exited the bullish control zone, got the divergence signal, and now here we are headed down. We also have a bunch of red histograms. We have lost the slope line. It's flipped over red, and we're getting ready to have the 821 cross to the downside. Potentially come back down to $66, maybe, $69 and find support. Got to be real careful with oil too. This thing's still at 50% of its all-time high, and it's in a macro, very bearish pattern. But we won't be able to see that because of this little guy right here. So we'll Just take my word on that. We were at $144 and we're putting in a series of lower highs. So over like, I mean, what, 15 years or something? Maybe 10 years. ICLN, Clean Energy ETF. You know, this is like your renewable, solar, all that good stuff. Wind power, hydro. You know, basically in a bearish pattern, trying to move to the upside consistently and failing on a regular basis. I do think that this is going to sell back off here and retest our red resistance turn support, hopefully. If not, we're going much lower. So those are our basically like ETFs and sectors in the market. Overall, seeing quite a mix there, but not looking particularly great. Some better than others. So Tesla now, let's look at Tesla. Tesla has, you know, we put in the high back here a while ago, broke down from it, put in a low, put in a lower high, put in the same low, put in another lower high, took profits on our Tesla trade up 20%. Again, we had a 3-to-1 risk reward ratio. We had like a 7% stop loss if we broke down from this and put in a new low, and then we had a 20% gain to the upside. So if we flipped that coin and we were right, we made 3 times as much as if we flipped the coin and we were wrong. So that's a obviously good trade. We also topped out at a key Fibonacci level, exactly where we expected. You can see where we took profits on the trade, and since then we broke down from it, came back up and put in a lower high, and now we're continuing to break down. If we find support here in this area, it would be support off of our resistance turn support, our support from the move up here as well, and then we could potentially come up and put in a new high, but I don't particularly love the price action on Tesla. And then also if we switch over to the weekly and we turn off our drawing tools and we turn on our moving averages, we will notice here that we got, you know, basically the 821 cross to the upside at $48. We ran all the way up here to $900. And now since then, we got the hard sell signal at the top of the range, multiple red histograms. We have lost the slope line. It's flipped over red. And now here we have crossed the 821 back to the downside, crossed it back to the upside and got the hard buy. Usually we would see a powerful move after that. Instead, we got 2 bearish candles in a row and got rejected on the weekly. So we need to be very careful. If we close at or below this level here, we're going to cross this 821 back to the downside, and we're going to revisit these lows at 555, maybe even lower, to our next substantial support range at 455. So Tesla looks bad right now, but one of the better overall tech stocks. Sad as that is, that it looks bad and it's still one of the better. Airbnb on the daily. This has basically, you know, it came onto market at $145, sold off down to $120, went all the way up from there to $219, and then it sold off 88.6% of this move to the upside, came back down, found support. We were able to take a, you know, decent little trade in that. Unfortunately, it did not hit our target right here. And then once the 821 crossed back here, it went in downtrend. 821 crossed here, and then that was rejected and it's headed back to the downside. I have no interest to be in a losing trade. So if we lose this level at the 786, I would just get back out of this trade flat, as it's not worth taking a loss on. Could have easily taken profits sooner than that. I did expect this to move up more powerfully than the 618. It still could. We could easily get back up to the 0.5 and hit our target. But if not, we just, you know, basically get out of this trade even, and it's a flat trade, and we'll wait for the next one, or we'll re-enter from a lower level. This looks to me like we could easily have downside, more downside potential. At this point in time, this candle is extremely bearish. You know, obviously a very, very red candle. We had gained some momentum to the upside. We had left the bearish control zone and looked like we were going to be putting some positive price action, but we could not get above the 8 moving average, got rejected, you know, week after week after week. And it looks to me like this is going much, much lower. You know, once we lose this level at $134, which is just above where we're at, or just below where we're at right now, there will be no support on the weekly below us. So, you know, other than the little wick that we had down here or the little wick we had right here, it's literally just free fall at that point in time. This looks very, very bad. Very, very bad right now. Could it still turn around to the upside? Yes, but it looks very bad. All the price action at this point in time, basically, that has taken place is, you know, this is just to kind of get a little perspective on what's going on here. Anyone, you know, from this entire range, all this is negative pressure because it's above us. All these people just want to get out even. All these people just want to sell and be out of this position so they don't take an L. And then this itty bitty little sliver right here, that tiny little bit of price action that took place down here, you know, that's the people that are in profit. There's somebody that bought the absolute bottom here, and if they didn't take profit, came all the way back down, you know, they bought the bottom here again maybe, or somebody else did, but everybody else is at a loss right now. And then this tiny little sliver right here, this tiny little sliver right here are in a profit. So that is typically going to lead to a bunch of selling pressure. Any move that goes to the upside at this point in time is probably going to get sold into very powerfully, and this is going to get pushed down. Does not have to happen, but looks very likely to me, especially after the 821 just got rejected here. Bumble, another one that, you know, basically IPO'd all the way up here, topped out, sold off. We got the measure move of this bearish descending triangle, hit the target to the downside perfectly, started consolidating, got the hard buy signal, multiple green histograms. We took the long trade here, 42% to the upside, absolutely phenomenal. Again, very high risk reward ratio. We had a 3.75 risk to reward with like less than a 10% stop loss, 42% gains. We flipped the coin. We could either lose $10 or we could gain $40. And, you know, we did in fact gain $40 per, well, in that example, but 42% on Bumble. Obviously got the 821 cross, looked good, came up here and identified this area as the trouble zone. This was our retest, not only of the 0.5 of the Fibonacci level from the top to the bottom, it was also the support from our descending triangle, which then we would expect to act as resistance. We took profits at the dollar sign right here, and then since then it has sold off from $57 back down to $48. So if we were bullish on this, which I am not, we could easily buy back in now, and we would have 15% more shares, plus we would have logged in our profit along the way. So, and obviously we have the hard sell signal, bunch of red histograms. You know, this looks very bad. We couldn't break above this level. If we come down here and put in a higher low somewhere along the way, maybe we can save this price action. But again, all of this is now selling pressure. Everybody that bought Bumble, you know, from here to here, this is all selling pressure. And then there's this itty bitty little bit of people that are in profit right now. And, you know, maybe they don't want to go negative, or maybe they're us and we bought down here, but we already sold right here. So maybe there's nobody left that's in profit on this thing since it became public. So very bearish chart. Trading extremely technically though, which is what we love to see. Okay, so next we have Baidu. I'm going to turn off the moving averages. Baidu topped out, sold off, putting in a very clear descending triangle bearish pattern. I do not like this at all. You know, it looks very, very weak to me. Chinese stocks obviously do not look good right now. I love the chart long term, but I'm very close to just being out of this position and being done with it for now. You know, we had a nice potential for a big move to the upside. Again, identified this as 3.3 to 1 risk reward ratio. You know, 11% potential stop loss, 37% potential gain. Not interested in taking a big L on this one. So going to be, you know, basically chalking this one up as a loss if we do continue to the downside. If we look at the longer time frames and take off our drawing tools, we will notice also that this chart is looking particularly bad. You know, we had gotten the 821 cross back here at $111, ran all the way up to $350, got the 821 cross back here to 220. Try to take a buy off the 200 exponential and simple moving averages. Again, we have the hard buy signal. You know, we have a couple green histograms in a row, but it does not look good. We really need to see some strength come out of this before it is too late and we end up getting pushed down. Also on the monthly, we have failed to hold the 8 moving average. We're holding right here, but you know, we have the hard sell signal now, multiple red histograms in a row. There's quite a bit of support below us here, but this could very easily just get smashed back down to like $130. And again, I would rather be out of the market on the sideline, waiting for something to clearly show up, some strength to come back in, rather than taking a large loss or being stuck in a position that I don't want to be in anymore. So Alibaba, slightly stronger, but we put in a low here, put in a lower low, put in a lower low here. So while we did get a slight little bit more of a reaction rally here, we're putting in consistent lower highs and lower lows. Again, Chinese stocks looking very weak here. Not a place that we want to be. The 821 crossed down here, tried to recross, got rejected, and now we're selling down. We did finally touch the 200 exponential and simple. We did get the weekly hard buy signal. We do have multiple green histograms on the daily, but overall, if we lose this level here at like 196, there is no moving averages below us. There's quite a bit of support through this range, as we did trade sideways basically for from 2017 to like 2020. So we have 3 years of sideways action here. Quite a bit of volume took place, but we really just don't want to end up in a situation where this thing just loses let's go, and we're stuck in it. So very, very closely monitoring this one, de-risking from these Chinese stocks, as overall they do not look good technically or fundamentally. TME, 10-cent music, once again, very, very bearish chart. This was looking like a left shoulder neckline, head, and then neckline, and we broke down from the neckline. Is it possible to reclaim this, come all the way back up to like 1733? It is 100% possible. We're showing some strength here, but we're also showing quite a bit of weakness. I do not like how this looks. Again, we started off here, moved up, came down to a new low, moved all the way up to a new high. So we have from the high back down to the low. We have retraced 78.6% of that move. I'm sorry, from the low to the high, we have retraced 78.6% of that move. That is not good. If we can find support here and move back up, we could potentially put in a lower high. We potentially put in a higher high. We do have, leaving the bearish control zone, potential cross of the Stochs right here. But again, multiple red histograms. 821 are powerfully crossed on the weekly to the downside. Slope is powerfully crossed to the downside. And if we switch over to the monthly, this looks extremely bad. Just big red candle after big red candle, all red histograms. Very clearly Stochs are sloped to the downside. And again, this whole entire zone that we're paying attention to, this is all people that are underwater in a position at this point in time. So this is all bad trades or bad places to buy. And then this itty little bit right here was people that bought at a good time, if they didn't sell, obviously. So there's very, very little support below us at this point in time. And if we break through this level, it's probably going to go to one of our other Fibonacci extensions. Monthly time frame looks very bad. The Chinese stocks look very bad. We have already broken through a key support level. Not good. Diddy obviously has been in the news like crazy lately. They probably, they full knowing that they were going to be under investigation from the Chinese government, still IPO'd even after the government told them not to IPO. They gapped down massively from $15 down to $11, came back up and tried to close that gap, tried to fill the gap. We made it back up to the 382 from the top to the bottom, at which point in time we got rejected. This is a very bearish looking candle. This is on the 4 hour just because there's no trading, to look at basically. We had a very powerful rejection here, went down, came back up, got another rejection here, came down, and then back up, and now we're getting another rejection as well. So and there's so little price action that we basically can't even use this right now. So can't even switch to a longer time frame, and it's pointless to switch to a shorter time frame. So Kanzun Music, or I'm sorry, Kanzun Limited rather. BZ. I was thinking 10 cent. Same type of deal here. We have basically a, became publicly traded, moved up, sold down. Kathy Wood bought right here, trying to buy the bottom, buy support. And then since that, we immediately gapped down right afterwards. I called this move down as well. It's basically a overnight. Overnight, she went down 22+%, came back up, filled the gap, and is now getting rejected at our support turn resistance. She was immediately upside down in this position, still upside down in this position, and there's very little, information to use. We did close above the 8, but could not get above the 21. So we'll see. There's going to be a lot of overhead resistance. People might have took that scalp back to the upside to close the gap, but it's going to be a lot of selling pressure. It'll be very difficult to get back above that area. NEO is next. China EV stock. Again, showing some weakness. 821 has crossed back to the downside, putting in another lower high. We had a support level through this range, came back up, put in a lower high. We are now selling down, seeing a bunch of weakness on the daily. If we switch over to the weekly, the Chinese stocks not looking good. We got the 821 crossed back to the upside, and now here we are back at it again. If we close here on the weekly in the next 2 days or whatever, we're basically going to cross this back down to the downside. Did get the hard buy coming out of the bearish control zone. Got some positive price action, couple green histograms, still red slope line below it, and now we're seeing weakness coming again. Looks like a lower high rejection, at which point in time I would expect us to put in a new low somewhere around $29 or maybe as low as $18. This looks very bad right now. There's still some potential, but it looks very bad. And I think that this is a good time to talk about, Chinese stocks are basically, China is a couple months ahead of the United States and Europe and the rest of the world in, the whole pandemic and what happened here. So, they had it first, they recovered faster, and now they're putting in lower highs and the markets look extremely weak. So is that saying, telling us what's happening in tech sector, telling us what's going to happen to American or European or, other stocks as well? There's definitely a possibility. So have to be very careful here. Peloton put in a high, broke down violently from the high, all the way from 170 down to $80. I mean, this thing lost over 50% of its value. Came back up to the 618 and underperformed, got rejected here. We were expecting it to get as high as the 786, and now it just looks like it's putting in a high and then a low and then a lower high. So we would expect next a lower low. If this thing does break, it could be in big trouble. It is so far hanging on slightly to this little cross to the upside. It is still technically crossed 821 to the upside, but if we close here this week, I would expect further downward action and this cross back to the downside and weakness to start showing up on our indicator oscillators as well. So Peloton does not look good. Etsy basically sold off, came back down. Again, the fact that we had some of the most powerful stocks, basically lose 30 to 75% of their value, not great. We did break back through this area, this very strong resistance / support area here. Got to poke back up to the 618 from the top to the bottom, retrace 1.8% of that move, and then we violently sold off. We have lost that blue support level that we were hoping to hold on to. We have lost the top of the channel that we were hoping to hold that support. It is still possible we hang on here, but we have the hard sell signal. We have a bunch of red histograms in a row. This is a underperforming trade setup here, and once again, not interested in being in losers. I would rather re-enter at a later date. Sold off here, lost 821, and now here we're about to lose the 821 again. We did get the hard buy signal coming out of the bearish control zone. We did get multiple green histograms, but we're well below the slope line. The slope is still red, and this looks like a lower high rejection and appears that we will be getting continuation to the downside. It's not over yet, but it's not looking good. ARKK, Kathy Wood, obviously. So let's talk about her. She obviously had a phenomenal year, opened up a ton of her ETFs, actively traded funds, did well, topped out at 158 here and sold off down to 96, lost basically 33+%, 38% of her value. All these are extremely underperforming, broke through here. So basically, if you bought anywhere from, at this point in time, where we're at now is where we're at in December of last year, beginning of December. So everyone thinks she's like this great oracle and whatnot. And if you didn't get in early and you waited and you bought into the momentum on this, she now has over 7 months of flat to losses. So that is not good. 8 months almost. So well, I called it. I told everybody ahead of time. This is where ARK was obviously looking absolutely terrible. From the top to our bottom right here, we got a bounce. I was expecting the 786. We underperformed. We took the entry on ARK. This is the ARKK Innovation Fund. We took this a 26% potential to the upside with a 7.5% to the downside, but we did take profits at the dollar symbol here in the group at the 618 as this looked extremely weak and felt like it was going to underperform. Still worked out nicely as our entry to profit ratio. We still got 15.7% profit on that position, but it was definitely showing some weakness. Markets were showing some weakness, and we took that as a sign to just get out. Hard sell signal, leaving the bullish control zone, bunch of red histograms in a row, and now here we are getting ready to crossing back to the downside, breaking back below that level. Looks like we have a high, a low, a lower high, and we would expect this to continue selling off and put in a lower low. And this is the best of the ARK funds performance-wise. The other ones just look worse. So ARKF, extreme underperformer, looks absolutely terrible. Did not take a position on this one, as again, you know, could not even get past those previous resistance level at the 618, could not even make it up to the 618, sold back off here. I would expect this to continue selling off, only showing weakness on the daily and also on our weekly time frame. Looks like it's about to break back down the 821 below the slope line. Red histograms, still has potential, but does not look good. Keep in mind also, this woman dumped all of her Apple stock at the bottom and has only bought losers for the last like 6 months. So careful there. She is changing her tune to the macro deflationary environment though, so that's good. I'm glad that Kathy's finally coming around, but you know, apparently she does not watch the channel enough, or she wouldn't be taking all these losing trades and literally getting 20% haircuts on her positions overnight. Square looking rough here. We got a high, we have same high, we got a lower high now, hard sell signal, a bunch of red histograms. You know, looks like it wants to let go. It bounced the 200 exponential a couple times, still hanging on to the positive cross. Did get a buy, couple green histograms here, but looks like it is probably headed lower. I would rather be in this than banking stocks. eBay, we got the break of the ascending triangle. Unfortunately, I did not take this trade as the breakout did not hold. I wanted to see this breakout, find support, and then continuation. If it comes back down here again and holds, maybe I will take that position. But anyone that did take the position obviously did pretty well. But now we're getting quite a bit of bearish action. Hard sell, bunch of red histograms, getting ready to break down below the slope line. Overall, eBay still looks different. It's still up at all-time high levels, but is definitely looking like a rejection at this point in time. We can see here from the all-time high, we have now taken out that previous candle, completely bearishly engulfed it. So I would expect, if this area doesn't hold we're at right now, I would expect $65 to hold. If that area does not hold, it's going to look very bad as it breaks down and essentially turns into a giant throw over pattern, which is typically how you trick people into buying the breakout, and then really you're just dumping on their face. PayPal looks like it may be double topping, still decent. We did basically get a nice trade setup out of it, 17% to the upside with a 7% potential stop loss, 2.5% or 2.5x ratio. Do still have further targets to the upside, are still in the bullish control zone, but we are losing strength here. We're putting in some slight bearish divergence. Got to be careful on this one. Still looks better than most though, but not quite making all-time highs. Still in this position for now, but if it starts to give back our gains, I'm not just going to give them away. I will just take profits and get out of this position. But could have potential, could double top. We got to wait and see, honestly. Apple still in this position for now. Keep in mind, Apple, Kathy Wood dumped her entire Apple position, which is now up from when she sold her Apple, is now up 24%. So it has basically overperformed just about anything in that same time period. And she sold her complete Apple position at the absolute bottom and then bought everything else at the top. So careful listening to Queen Kathy, as she obviously does not know what she's doing. It's easy to pick winners, when everything is a winner. It's harder to pick winners when everything is a loser. All-time highs on Apple here, looks very strong. Did well with earnings. We are getting a hard sell signal, but still all green histograms, still blue slope line, still in this position for now. Apple is probably one of the strongest looking of anything right now. We saved the 821 cross. We broke out to new all-time highs. We got to be careful we don't get rejected off the slope line here, but overall, Apple looks phenomenal, especially compared to everything else, which looks subpar. Amazon looking decent right now. Finally broke out after that year-long consolidation pattern. Finally broke out to an all-time high. Topped out at the 1.236 Fibonacci extension from the high to our bottom. We were just operating inside this channel. Finally broke through the channel. Hit our next fib target. If this holds long enough, I expect continuation to the upside. I am currently still in Amazon, but I don't love how it looks after that much consolidation. I would expect a breakout, possibly retest, and then continuation. If we break down back inside that channel, back below $3,549, this is not going to look good. nothing terrible showing up here. A little bit of red histograms, a little weakness. Got to be careful, but Amazon, you know, blue chip as it gets pretty much. So, all right, let's check out our cryptos, see what's going on in chat over there. What's up, guys? If you're still alive in chat, say what's up. Let me know where you're from or how you're doing or whatever. Bitcoin on the daily still looks very weak. Cannot cross the 821 back to the upside. Sell, buy, sell. You know, this looks extremely weak. Extremely weak. On the weekly, looks even worse. 821 have crossed to the downside. We are in the bearish control zone. Bunch of red histograms in a row. Red slope line. Nothing bullish on the weekly. And on the monthly, broken down from the 8. You know, Bitcoin futures headed down to 2,700 if something doesn't happen soon. Left the bullish control zone. Hard sell signal. Bunch of red histograms. Extremely bearish. Looks absolutely terrible. Bitcoin spot market on the daily looks just as bad. Sell, buy, sell. I mean, this area needs to hold. It looks like a big descending triangle. Looks like a big head and shoulders pattern. Looks like an extremely toppy pattern. It's looking like we're just getting a bearish reset right now. If we turn moving averages, 821 cross to the downside, sell by sell at the top of the range, bunch of red histograms. You know, we basically called the exact top on this, and now it's in the bearish control zone. All red histograms, red slope line to the downside. Looks absolutely horrendous. Absolutely horrendous. There's nothing bullish in the crypto charts right now. We are holding this green slope line for now. We need to continue holding that green slope line. We do not want to retest 20,000. That has never happened before when we broke out to a new all-time high and then retested the previous cycle high. Hopefully we hold somewhere around this $25,000 range. This looks extremely bad. Extremely bad. And then switching to the monthly, hard sell signal, multiple red monthly histograms in a row. The last 2 times we got this was the top of the bull run, 4-year cycle, top of the bull run, 4-year cycle, top of the bull run, 4-year cycle. We don't know yet, but sure looks like it. Sure looks like it. Very bad. Very bad. Ethereum is next. Ethereum, again, looking very weak. 821 cross back here. Tried to cross it back here and failed. We're barely hanging on to the 200 moving averages. Daily looks like there could be some potential, but 821 about to cross on the weekly. Hard sell signal coming out of the bullish control zone. Divergence signal. Bunch of red histograms below the slope line. It is still blue. We have not crossed 821 to the downside. Ethereum looks better than most, but barely hanging on right now and about to retest the previous all-time high. If we break down, we could lose like 40% of our value. Hard sell signal, left the bullish control zone, red histogram on the monthly. This thing looks bad, but better than most. Dogecoin, all the memes are dead at this point in time. They're all dying or dead. Dogecoin has seen nothing good happen in the last, weekly is about to cross to the downside. All red histograms, sell signal at the top. This thing has no strength, and it's just literally selling off, consistently just grinding down while people just hodl. Crypto cap on the weekly, got the 821 cross to the downside. The entire crypto market cap has crossed to the downside. It is all red. It is hard sell signal. It is red slope line. It is the histograms below the slope. Everything looks bad here. We're headed straight back down to 1.16 trillion. We have lost over from the top at 2.6 trillion. We're at 1.3 trillion. The crypto market cap has been cut in over half. 50% of the value is gone for people hodling. Hard sell signal on the monthly at the top of the range. Multiple red histograms. Barely hanging on to the 8. Looks absolutely horrendous right now. Zero strength from the bulls. Bitcoin dominance gaining a little bit of strength. Cannot quite get above the 8 moving average, but we'll see what happens here. Getting the hard buy signal out of the bearish control zone. Multiple green histograms. Trying to show a little strength. Signaling that altcoins are losing strength and Bitcoin is gaining it back after Bitcoin has been consistently losing strength. Still in the bearish control zone. Still all red on the monthly. Trying to show a little life, but doesn't look particularly great. But daily is starting to show a little strength. We'll see though. We'll see. We'll see what happens here. XRP did not make a new cycle high. One of the very few cryptos that did not take out its high from 2017/18. Absolutely pathetic. All red histograms, red slope line, hard sell signal in the bearish control zone. This thing is showing no life. I've crossed 821 to the downside. The monthly, this basically, once something doesn't make a new cycle high, it's just going to only ever get worse after that, typically. So this looks extremely bad to me. Extremely bad. Uniswap has broken down from key support level. Weekly is crossed to the downside. We are below the moving averages. All red histograms. Looks very, very weak. Very weak. It needs to hold this level at 1675. After that, there's like no support. No support. I mean, this thing looks terrible. Could go back to $4. It, could. Doesn't have to, but it could. Looks very, very bad. Chainlink, 821 have crossed the downside. It has lost the 50-55 moving averages. It needs to hold this level that it's at now, or 1350. After that, $9. I mean, this thing looks terrible. All red histograms, red slope line, bearish control zone. Uniswap looks very, very, Chainlink looks very, very bad. Polkadot, again, very bad. Very, very toppy. It needs to hold this level. If it does not, it's going to sell off heavily. Extremely toppy. Closing consistent weekly new lows. Next support level is at like $10 from here. Another 30% down. Hard sell signal at the top of the range. Bearish control zone. All red histograms. 821 have crossed on the weekly to the downside. Polkadot looks terrible. All these cryptos look terrible. BNB, one of the few that still looks decent. One of the strongest. The prettiest ugly girl in the room. Has not got the 821 across the downside. Is below the 8. Next support level needs to hold 255. If not, headed to 220. All red histograms. Below the slope line. Slope is still blue. Hard sell signal coming out of the top of the range. Looks terrible on the weekly. Crypto looks very bad right now. Cardano, ADA. It doesn't mean it's over, but it looks very bad. The weekly is still holding up for now. Hard sell signal at the top of the range. All red histograms. It needs to hold this level. Next support level is at $1. After that, 80 cents. Cardano looks very bad here. Looks stronger than most, but BNB, Cardano, and ETH are like the strongest cryptos. Some of the strongest. There's a couple other random shitcoins that are better, but they're the stronger ones, and they all look terrible. Coinbase is absolutely terrible right now. I'm getting back out of this trade flat at this point in time. I have no interest in trying to hold this and potentially going back down to a new low. This is absolutely pathetic. Basically came all the way down to the 0 line, bounced up, and could not even get back to the 382. This looks absolutely terrible. Hard sell signal on the daily, starting to show weakness. Coinbase has literally done nothing but sell off. We talked about this on some of the other ones. Just for perspective, anybody that bought anywhere but this one day right here, basically, 3 days right here, basically, which is us, or like 3 days right here, basically, is negative. This looks absolutely terrible. Absolutely terrible. I like Coinbase for the long haul. They make their money off of trading fees, not direction of crypto, but it looks terrible. Riot blockchain, it's directly correlated with Bitcoin. Tried to save the 821 cross, selling back off. Again, weekly on this is crossed to the downside. It looks terrible. 821 tried to save it, crossing back down, headed to the downside. Bearish control zone, tried to exit it, trying to get the hard buy signal, and now it's just losing strength all over again. Everything in the crypto space looks terrible right now, basically. MicroStrategy, pathetic bounce, failed, selling off again. Michael Saylor's cult is not doing well. He sounds like he has the old CVD, the old beer virus. I think he's probably going to do an exit scam or fake his own death or something soon, as his crypto positions will be over $2.4 billion, at one point in time. And now he's barely up 15%. Absolutely pathetic. And he borrowed all this money to buy Bitcoin and is not even up barely a couple percent at this point in time. His stock crashed down to a couple dollars previously in the dot-com bubble, and he's doing the exact same thing again using Bitcoin and crypto. Been in trouble with the SEC before. The stock pumped all the way up to $3,000 in the dot-com bubble, and it crashed all the way down to $4. His stock, MicroStrategy, Michael Saylor, the scam stock, went down 99.87% in the last crash. It lost 99.8% of its value. So if it was worth $100 at the top, it was worth 13 cents at the bottom. So keep that in mind. Obviously, they own Bitcoin, but who knows at what point in time, they will lose their Bitcoin or get liquidated or get margin called on all their loans that they have borrowed. Absolute scammer. Been in trouble with the SEC before. Probably will be in trouble with the SEC again very soon. Be very, very careful with MicroStrategy. Be very, very careful with this cult leader. Showing extreme weakness. Lost to 821. Extremely, extremely bearish. Very bad. Very, very bad. GME, all the meme stocks just getting crushed, like we said. The 821 has crossed to the downside. Topped out at 483. Topped out after that at 347. Topped out here again at 337. Told you it was going way down at 223. Here it's at 167. Next target to the downside, 131. This thing could literally just get crushed. Meme stocks look very bad right now. AMC and the Apes, the old diamond hands, they ate a little too much poop, drank a little too much of their own pee, and now they have upset tummies and pink eye, and doesn't look like diamond hands to me, boys. Sorry about them looks. Called that AMC was getting ready to capitulate at $51. We are now at $33 from the top to where we're at right now. The diamond-handed ape boys have lost 53% just since that call. Specifically back here, the diamond hand ape boys have lost 32% of their positions. There is literally no support. Pray to God that the gap fill is all it's doing right here and goes to $31. Could easily bounce back to the upside, but I just expect this to slowly just capitulate. Keep in mind, these are one-day candles, so you only spent 1 day, 2 days, 3 days, 4 days between $13 and $33. So there's 4 days worth of buying holding up price action right now. So pray to God or whatever apes worship. Pray to your diamond-handed ape boyfriends that they don't sell, because if they do, you are going to get absolutely wrecked. AMC looks horrendous. Horrendous. Looks like a waterfall getting ready to pour out all your gains or just straight up into losses. Bed Bath & Beyond, did exactly what we said. We were putting in two clear patterns, a symmetrical triangle and a descending triangle. I expected that we would basically come back up, test the top of the symmetrical green triangle, and then break down from it and come down and very clearly develop the red descending triangle. Looks like that's exactly what took place. Came back up, got rejected, sold back off. I expect us to be down here at $23 very soon. Looks terrible, but not nearly as bad as the other meme stocks. DraftKings, another one of Cathie Wood's absolute horrendous purchases. She bought and is now upside down on her DraftKings position. Tried to put the bottom in on DraftKings again. Absolutely failed. You cannot literally just throw millions of dollars at something and then tell everybody about it and expect the market to listen. You are not the market. You are not profitable. For the last over 1 year, Cathie Wood is delusional. She thinks oil is going to $3 to $12 in the short term. How about no? How about no, Scott? Feel bad for anyone that bought into the Cathie Wood, I don't even know what you want to call it, delusional mindset. I think in 5 years she will be doing better, but if you're smart, you don't just take 2 years of drawdown, 3 years of drawdown so that you can eventually be profitable again. You just are smart. You don't just throw all the money at horrible investments and sell the only good one you have, Apple. Everything she buys is negative. Literally. She announces it to the world and then it immediately goes negative. At this point in time, Cathie Wood is a meme. Whatever she buys, immediately short it. This is not financial advice. I'm not your financial advisor. If we sell off from this level, I expect us to retest $40. And then after that, you know, $35. Great job, Kathy. You are a meme. Newegg, another meme stock, pumped up here in like 5 days. Gave back the first candle in the last 5 days. Hard sell signal, bunch of red histograms. Our next 1 day candle, if that sells off, takes us down to 20. After that, we have 2 days worth of support down to 16. And then after that, we go back to where we were 5 days ago, which is at $10. So it has already lost from its high 63%. If it sells back off back to where it was, it will lose 85% of its value. Meme stocks are no longer working. Make sure that if you get in early, you got out early too. I would not buy meme stocks. I would invest in legitimate companies. Gold is showing a little bit of strength, trying to get back above its 200 moving average, but it could very easily get tired here and sell back off. We have a high, we have a low, we have a lower high. We really need to take out this lower high. We have a series of, you know, basically a downtrend, hard sell signal on the weekly, trying to save the 821 cross. We have 2 days to save it. Otherwise, it looks like a horrible rejection, and I expect this to go much lower. Retest the bottom of the range, 1700, maybe 1586. Gold looks bad right now. Silver looks slightly better, but losing strength quickly. Let's go to the weekly on silver. You know, the whole time it crossed 821 to the upside at $16, stayed cross to the upside. And now we are below it, getting ready to cross to the downside for the first time in, you know, over a year after this massive move up here and over doubling in value. Once this crosses to the downside, next target $24. After that, $23. After that, $20. The silver squeeze did not work. It is not working, and we are seeing a bunch of bearishness showing up here. And then the Zag gold silver chart is telling us that gold is basically gold lost value compared to silver since June of 2020. It was at 100 silvers equals 1 gold, and now it's at 69 silvers equals 1 gold, and gold is about to get more valuable compared to silver. 821 is about to cross to the upside on the weekly. Hard buy signal coming out of the bottom zone. All green histograms on the daily, crossing the slope back over blue. Gold is about to gain compared to silver, which means gold is probably about to sell off, and silver is probably about to sell off extremely, extremely violently. Much, much worse. XPT, trying to hang on to this 200 exponential moving average. Definitely showing some strength right here. It's going to be tough to get above these levels, but showing some definite strength. AG, First Majestic Mining, silver mine, looks terrible. Broke down from a key support level, this blue level at $15. I expect this to continue selling off at least down to $13. Looks very, very bad. Very bad. Aurora Cannabis. Look, this is a perfect example of how you don't want to marry your trades. Don't marry your views. Don't marry your technical analysis. When this turned, I told everybody this was turning back down to the downside, and it was looking like a lower high rejection and looking bad. Could we still find support here? Yes, but are we back at the entry from the initial trade? Are we looking extremely weak? Did we cross back the 821 on the weekly to the downside? Does this look like a rejection and we're going lower? Yes, all those things, yes. You know, I will be the first to tell you when something changes. I let the group know for sure that I was waiting for this thing to look like it's carving out a bottom again. I do not like how these cannabis stocks look right now. They look terrible. Tilray, same thing. Looks very, very weak. Crossed the 821, back down to the downside. If it falls down, it's going to fall to like 1360. Showing some strength here, but we broke down below the slope line again. I mean, this thing could just let loose. Could go back down to 11, 12 bucks, maybe even $8. I do not like how these pot stocks look. If everything else starts showing weakness, and they've been the weakest sector for years, I do not expect them to look good. Canopy Growth is like the weakest of the week. Again, topping out here, broke down from the 200, 821 cross stack to the downside. This looks absolutely horrendous. Canopy Growth could easily go to $18. I mean, or much, much lower. These pot stocks look terrible. THCX, same thing. Looks absolutely terrible. Descending triangle. YOLO looks absolutely terrible. Descending triangle. URA, it was the same thing with the uranium stocks. It was a great trade, but, you know, I told everybody I was expecting these to top out and sell off bearishly back at 22 bucks. You know, we're down 10% from that now. I expect this to go much lower. We have lost the moving average. I mean, we could easily go back down another 10% plus here. The daily looks weak. The weekly is barely hanging on. If the weekly breaks, I expect these back down at like $17. All bearish. Everything looks bearish. The long term still looks good, but you really want to hold the loser for a year. UEC, very bearish. Looks absolutely terrible. Looks like it's going lower. Again, that's why I don't get married to these things. As soon as the chart starts looking bad, I get out and I'll wait for it to show strength again. It was at 99 cents, went all the way up to 370. Our cross was at the 99-cent mark. Our cross to the downside was here at the basically 265 mark. It looks like it has further downside. Could easily bounce back up, but there's going to be a lot of selling pressure. Looks like a very, very clear double top, triple top. We spoke multiple times about all the divergence in the uranium space. Everybody was talking about uranium. Everybody was excited about uranium. Everybody was talking about silver and how great precious metals are. Does not look like it to me. Cameco, same exact thing. Same exact thing. Operating inside this channel for over a year, broke down from the channel, seeing no strength come into the markets here. Bearish control zone, all red histograms, red slope. I expect this easily to hit 1560 or the measure move of 1423. Everything uranium related just looks absolutely terrible right now. Short term to medium term. Too popular for too long. Copper, exact same thing. All the commodities. No one likes commodities. I was talking about commodities way back when. Nobody wanted anything to do with commodities. They went in this massive uptrend. I talked about copper breaking out of this bottoming pattern back at $20. This is CPER. It went up to $30. Spoke about the break of our channel. We broke down from the channel now. Tried to retest it. I am out of these positions and have no interest in them until they start showing strength again. We could easily see this back down at $22. I have no interest in all these commodities right now. I hold physical gold and silver, but none of this other stuff looks good. And even gold and silver don't look good. Lithium, by far the best. Broke out to a new all-time high, which is good. This is a battery ETF. LIT. Not even a new all-time high. New cycle high. Looks decent, but looks toppy here. Got to be real careful with this one. LBS1, lumber futures. Again, called the top way up here at, $1,400, 1337. Or 1377, and now here we are at $612. This may just keep breaking down. I thought we were going to find some support in this range. We barely did. Broke down from it, found resistance at that level, and now it's just letting go. And I don't think this is going to be able to recover anytime soon because no one's going to be wanting to buy lumber futures when all the lumber yards are just completely stocked on lumber. Let's look at the weekly. Looks absolutely horrendous. 821 cross to the downside. Everything bearish. Let's look at the monthly. Everything bearish. Looks absolutely terrible. There's no life from this. Hard sell. Multiple red histograms. Lumber looks terrible. Could we find support right here? Is this a key level? Yes. If we break down from that, we're going straight back down to like $500 or less. Absolutely terrible. Lumber looks horrible right now. All the people who tried to build a house when lumber was at all-time highs, ridiculously parabolic, now will never be able to sell those houses because their value will not equal what it costs to build that house. They may not even complete construction. Many companies will probably go out of business because it's more profitable to just close down and start a new business than it is to finish all these houses they agreed to make at a loss. Very bad for the economy. Caterpillar, long-term trend up here, broke down from the trend. Looks like it's about to go much lower. All the industrials look bad. Deere looks the same, slightly more bullish, but overall the same. Broke down from that level, trying to find support. Looks like it's just going to put in a new lower high. Selling off. Looks bad. Antero Midstream Corporation, AM, looks bad. Same exact thing. Breaking down from key levels. 821 about to cross the downside. If it loses this level, I am out of here. Bearish divergence. I was calling it out ahead of time. I have no interest in just riding these things back down and losing my profits. Cemex CX, same thing. We were inside that same exact channel. The whole, infrastructure trade was great. Everybody was talking about infrastructure, the infrastructure plan. We literally rode all the way up in this channel. Same channel that all the industrials were in. And now here we have broken down from it. No longer have any interest in being inside this. We came back up, tried to get back inside, got rejected, going much lower. $6 or $5. Maybe we save this level, but it looks very bearish to me. All this stuff looks very bearish. CLF, we spoke about this one specifically for a group member. Steel company, same exact channel, same exact price action. And now here we are. We tried to push back up, put in a lower high, broke down, trying to find support. If we break down from this level, we're going much lower, down to $15 or less. Does not look good. Does not look good. None of the industrials look good right now. None of the commodities look good. Barely anything in these markets look good. I looked at probably over 300 charts the other day, and I think I found like 10 that looked good out of like 300 potentials. Ford, barely hanging on. Barely hanging on. Again, I'm getting ready to drop this one like a hot potato if we break down from the support level and lose this channel. Same channel on the way up. Nice profitable trade. Getting ready to give it all back. Not me. I don't think so. It's at $14 now. Could easily go back down to like, $10, $9. There's quite a bit of support here at $10, but I have no interest in riding this thing straight back down to the bottom. No, thank you. Whew. All right, we did it, guys. Took a while. I definitely went on a little educational thing at the beginning. I hope you guys enjoyed that. I know it was a little something different, but I wanted to offer a little something different and answer a bunch of questions for group members that had proposed them. So I hope you guys enjoyed the stream today. Yep, and I will get with everyone in the group. If you're not in the group, you want to be in the group, shoot me a message. My email is available if you go to the channel page and go to contact or about, and then go to contact, send me an email. Feel free. We have more than willing to have other group members join the group. We have members from all over the world. I interact with you live in real time, chart whatever you need. I show trade setups, risk reward ratios, answer questions, do all kinds of teaching and whatnot. If you're interested, let me know. I appreciate everybody that is a subscriber to the channel, member in the group, all my regulars showing up all the time, all the positivity, all the people that are eager to learn, make money, support their family. I appreciate all you guys. This is a crazy time right now in the markets, the absolute best time to find opportunity. Anybody can make money in a bull market. Right now, we are in a crazy, crazy period. There's a ton going on. This is the best time to be in a good community with strong people around you that are not being clouded by, their own personal judgments or their perma bull status or, their hodl mentality, etc. So I appreciate everybody for tuning in today. If you're watching this afterwards, please feel free to leave a comment. Let me know where you're at. Let me know what assets you like, what you don't like, what you learned today, anything. Just give me a like, a subscribe, a comment. Helps me out, helps the channel out, helps you out if I answer that question. If I don't answer that question, I probably didn't see it, but 99% of the time I do. So that's it for our Wednesday midweek market wrap up, guys. Be careful. Jerome Powell was saying for the Fed all kinds of dovish things he was saying, but there was a very hawkish tone to what he was saying. So I think the market is starting to pick that up. They're saying, oh, we'll do whatever it takes. There's all this information saying, factual information saying that there's inflation, but Jerome Powell says, but we feel. He says, there's actual technicals and information and facts saying this. And then he kept saying, but we feel. So Jerome, are you using your heart? Are you using your feelings, or are you using technicals and math and science? Because actual correct information comes from technicals and math and science, is provable, repeatable, etc. Your feelings, though, your feelings, the way you feel, your heart, that's not the best thing to go with. So it's going to be real bad if he's wrong for everyone all over the world. So let's hope that he is wrong and the inflation is transitory and all this other stuff, and that the mortgage-backed securities aren't making a bubble. And, he specifically said about treasuries, they were like, what do you think about the $80 billion plus in treasury mortgage-backed securities and $40 billion in mortgage-backed securities and $80 plus billion in treasury purchases? He goes, oh, everybody wants treasuries. There's huge demand for U.S. treasuries. U.S. treasuries are the safe haven. Everyone runs to them. Everyone wants them. If everyone wanted U.S. treasuries, why are you buying 80 billion plus U.S. treasuries every month for over a year through emergency times and continuing to buy them while the economy is doing great, fantastic, while it's bouncing back and it's super strong and everything's great? but you still have to buy $80 billion in U.S. Treasuries, and there's huge demand for them, and the chart's barely going up, but overall going down. I don't know, Jerome. I don't know, Jerome Powell. Something's not adding up here, and I don't think they're buying your bullshit. I know I'm not. So, well, there you have it, guys. Gonna call it for today. Wednesday, midweek market wrap up. It is 10:41 on July 14th. I am Crypto Trend Trader, and I'm out of here.